And that tends to distort not only the payroll number, which I certainly think could swing into negative territory. When I was on this program last month, I said, take your December number, put a negative sign in front of it, and that's as good a forecast as any for January payrolls. I stand by that assessment. But on top of that, when we have a month where a lot of potentially lower wage workers were shut out, whether it was a snowstorm or they were calling in sick to work and not being paid for work, that means that the average hourly earnings, that wage metric, gets skewed to the high side. And I think that's a very real risk in today's numbers. So payroll distortion, also average hourly earnings.
Perhaps payroll distortion, perhaps we can't get that much in terms of signals from this report. But I want to sit on something you mentioned, that the base effect oil prices, which were expected to go down, they have not. They have continued to climb significantly, with WTI up 22% so far year to date. How does this feature into the lack of transitory, the idea of stickier inflation at a time when the other elements are also going up?
Well, it's sticky, Lisa, but it does appear to be growing at a slower pace. So, we had these easy year-on-year comparisons from the lows in oils. Now we're certainly not retreating, and I'm not so sure that we will retreat as the entire world bounces back from lockdowns and disruptions and whatnot. However, I think that the growth rate we've seen over the past year is going to be very difficult to sustain going forward, and that means energy as a share of that increase in the CPI or PCE deflator, pick your poison, is going to start to fade into the background, along with things like autos and airfares and hotels and other reopening trades. And when that happens, rents are going to come front and center. And what history tells us, that rent inflation does not revert until we actually head into the slack-producing event of an economic downturn. So Fed tightening doesn't calm the rent situation, a recession does.
So Governor Bailey of the Bank of England said that he doesn't want to get this to be a stickier phenomenon, recommending people don't ask for pay raises, as John was mentioning. Do you think that that's the answer here in the U.S. as well?
I don't think asking people to not want pay raises is a very economically productive. So I think Jay Powell will steer clear of a blunder of that sort.
Carl, thank you. Carl Rigodano of Bloomberg. Thank you, buddy. It's good to catch up. You just can't ask for big ones. I mean, can you imagine the governor of the Bank of England, you earn north of 500K a year, sterling, and you're telling people not to ask for a big pay rise this year. It's not exactly the greatest message to be sending after you've just hiked interest rates, Tom.
Yeah, I think it's something we have to talk about. That was the oddest jobs day conversation we've ever had with Carl Rigodano, because this is the oddest jobs day ever. I mean, we've got the, Omicron and all that, John, but this is about cost of living. And frankly, your conversation with Secretary Walsh today is going to be fascinating. John, a surveillance correction, we've got to do it.
Go on.
And this is the acuity, the accuracy of Bloomberg. We go to 3 decimals here on surveillance. So does Javier Blas. His wonderful book here on oil, and of course out front on AAA unleaded. John, we go out to 3 decimal points to squeeze out a new high on AAA unleaded. That's now official on the Bloomberg terminal.
We've got a problem, haven't we? It's a big, big problem, and it could be hanging around. And to Lisa's point, the base effects, yes, they are set to kick in after Q1, into Q2, into Q3, and that's why the likes of Standard Chartered think the Federal Reserve will front-load rate hikes, get it done, and then inflation's going to fade, and we start worrying about growth in the second half of this year. This is what Bank of America said this morning, Tom.
Please.
Silly old bear, we're bearish. Inflation shock in the first half, second half of 21. First half of 22 is a rate shock. Back half of 22 is a growth shock. And for that reason, for them at least, negative returns in credit and stocks.
Well, I don't know about the negative returns of stocks. We're not in the business of gaming the market, but I'm watching growth.
Not my view. Bank of America's, Tom.
But I'm watching growth, and I would suggest J.P. Morgan, Bruce Kasman's way out front on this with this quarter sub 2%. That's slow growth.
And those estimates for the year, Lisa, they are coming in. They're coming in a little bit more.
But there's an argument, and Mohamed El-Erian has made this argument, which is we are going to get to a slower growth, slower inflation regime. It's how we get there, right? And what we're seeing right now is even if the Fed does nothing, you are going to see that slowdown. It might just be sharper because they'll have to move faster, and frankly, because the consumer appetite to buy is going to be that much more reduced when they see their real income go down so much. So it's such a difficult moment to know how this feeds into Fed policy, considering the lack of real wage growth. That's not the same as 1970s.
So this is a big question for earnings, for the equity market too. Have we met the limits of pricing power in America? Wasn't the story in 21, is it the story in 22?
It tells you everything that you need to know that Amazon increased the price of their Prime membership by $20, and the stock surged by some 15%. That basically they were saying, we can pass this on, and everyone cheered. So, I mean, at a certain point, it seems like they can kick things up.
You know, the first thing I thought of, Tom, when I saw Prime going up that much, I thought, Prime is that much? I need to recheck this. Maybe I won't hold on to it. That was the first thing I thought. I don't use Prime Video anymore. Barely watch the thing. I'm not sure I get enough things delivered to warrant the 100. What is it now? $190 a year, Lisa?
It's like 134.
I thought it was going up a lot.
Yeah, but from very little. Really? That's the first thing you thought of?
I thought about cancelling it. Absolutely. I've gone through all the streaming, streaming apps, Tom, and thought, what am I using? What am I not using? I've got so many now.
Oh, everybody's doing
and
that.
I've started the cut.
No,
119 to 139.
Yeah.
The gaming on streaming is stunning. Variety has done phenomenal work on that. It's amazing how people watch Mandalorian and then they cancel it, whatever, whatever the story is. But on Amazon, John, they have a lot of math on this. The last 2 times they've raised Prime, people don't leave.
139. I mean, it just goes to show maybe they can take it to 190 and I'll stick with them. I won't, Lisa. I think that might get the cut. 139.
I think you're alone. I think there are more people who take it.
Honestly, the prices on Amazon aren't that great anymore. They used to be. I'm there for the convenience.
I'm going to bring you the soapbox next segment.
I'm going to Hyde Park Corner this weekend with Tom. We're flying in. Yields down a basis point on 10s, 181.67. Equities flat on the S&P. Just about positive on the Nasdaq, 0.5%. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Today's US jobs report could be a tricky one. The median estimate in a Bloomberg survey of economists shows a gain of 125,000 jobs in December, but the individual forecasts are all over the map, everywhere from an increase of 250,000 jobs to a loss of 400,000. Because of Omicron, revisions and seasonal factors, White House officials warn the report could be confusing or misleading. Hong Kong is coming out with some new steps to fight the coronavirus. Chief Executive Carrie Lam says tightened social distancing rules will be proposed at Tuesday's Executive Council meeting. The vaccine mandate will eventually require 3 shots, and rapid COVID tests will be handed out at all Hong Kong residents. A Republican senator is being widely criticized for comments about Ukraine. Senator Josh Hawley of Missouri says that the Biden administration should abandon long-standing support for Ukraine to eventually join NATO. He argues the U.S. should shift resources from Eastern Europe and focus instead on China. The White House says Hawley is parroting Russian talking points. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Technology is inherently a cyclical industry. There's a little bit of Peloton in everyone, okay? There's a little bit of Netflix in everyone. There's a little bit of PayPal in everyone, right? And now maybe there's a little bit of Facebook in everyone.
Just sort of brushing that Facebook off me and hoping there isn't any Facebook in me at all. Tom, you got any Facebook in you?
No, I have no Facebook
Lisa?
in me. The Peloton in me is just
my pinky.
I don't think no one wants that on them. Mike Wilson there of Morgan Stanley. What a move yesterday. Equity futures negative a little more than 1/10% on the S&P. On the Nasdaq 100 up 0.4%. Yields coming on a Treasury on a 10-year by about a basis point to 181.67. Payrolls 1 hour and 42 minutes away. Tom, look out. BTPs in Italy. 10-year yields up 21 basis points yesterday.
Explain to our audience why this is important.
Basis points, because we're set up now for this central bank of the ECB to pull back from QE quicker than anticipated, and then ultimately perhaps set up a rate hike too. Big move in the Italian 10-year.
Okay, so let's go back to the currency market, John, and it's really back to the 70s and the Deutsche Mark as well. The basic research I see today is euro ascendant, maybe dollar level ascendant, sterling weaker. That seems to be the play. Kachuk's featured that among others today as well. Is that how you see it?
Yeah, Deutsche Bank picking up on this, Tom. The big moves we've seen in the last 12 months have been off the back of central bank pivots, the Federal Reserve in focus. The big pivot we saw yesterday from the ECB, and let's be clear, it was a big pivot. Going into that news conference, we thought that the ECB president would hold tight, that T word. That T word crumbled in that news conference in a massive way. We started this week, Tom, by talking about changing probabilities. Where would the upside surprise come from the Fed, and given how low the bar was for the ECB, could that be the one to look out for? And that's how it's played out this week.
Yeah, Jordan Rochester, Nomura, good morning. Genius here on weaker sterling. That seems to be a call out front. Right now, Genius on Amazon. Poonam Doyle joins us, senior U.S. retail analyst of Big Box Bloomberg Intelligence. Poonam, what an interesting story as Amazon generates 9.4% revenue growth. You're telling me that prime up $20 matters? Is that picking up dimes in front of a bulldozer for Amazon?
Harry didn't take up the invitation, but I certainly think it seems like an olive branch.
If you just do the math, I mean, this is rough math, $20 increase on a base of roughly, let's say, 140, 150 million prime members, that's $3 billion flowing to the bottom line. That's huge. They're expected to generate $30 billion in profits, operating profits next year. So roughly 10%. It is a big number, and that's why it matters.
I noticed in the research yesterday, I'm sorry, folks, I don't know who to cite. Maybe I should cite Poonam Goyal. That online Amazon ability is about 40% of online business. Do you just see them relentlessly growing that out above 50% to 60 to 70%?
I wouldn't go as far as 70%, but I do think they will monopolize the online retail space. Amazon does about more than $450 billion in sales. We have forecasted that their GMV could reach $1 trillion. So you're talking about $1 trillion business online. That's huge, and they will be the biggest online retailer, no doubt about that.
Poonam, do you think that what we saw in terms of earnings yesterday justify a nearly $200 billion gain in the market cap of Amazon?
I think the story is going in the right direction. Amazon for a long time was about driving top line and not worrying about profits. Today, we're seeing them drive profits. And it's not just the Prime membership increase, but it's also AWS. AWS, which grew 40% in the quarter and accounts for over 70% of their revenues, that business is flourishing. They drove a 30% operating margin, and our analyst on the cloud side thinks that they can go to 35% over the longer run. That's huge.
So who are they winning from? Because it's multifaceted, right? AWS, maybe they're winning from Azure over at Microsoft, or maybe from Google. We'll see. You look at the pricing power, they're winning from a lot of retailers. And then there's advertising that they're actually starting to break out for the first time because they view this as a growth area. Are they just monopolizing every business from all of the other tech giants?
I wouldn't say they're taking share from anyone. These businesses are growing as a whole. So there's plenty of room for Google to grow and Microsoft along with AWS in the cloud front. On the advertising front, roughly $10 billion, still small, right? And there's plenty of opportunity for them to take more share there as they ramp up their Prime Video and other features on the Amazon platform.
Poonam, did they not split yesterday because Google got out front of them? Do we wait a decent amount of time? And do you just assume they join Microsoft, they join Apple, they join Google with a split, they join Tesla with a split?
Oh, your guess is as good as mine on that, Tom. Amazon, we really think that company is on fire to continue to move forward. How they decide to engineer their financials is really a guess between me and you.
I think a lot of people, Tom, not waiting for the stock split, Poonam, they're waiting for something big, like spin off AWS. Poonam, is that part of the conversation or just something that's sort of on the periphery when people discuss Amazon?
I mean, it's come up, but we don't think that's likely. Remember, AWS generates more than 70% of their profits. If they want to continue to invest in the retail business, they're going to need those profits. So spinning off AWS would limit their ability to go and invest forward to really dominate the infrastructure needed and the transportation that they need to build to fulfill these online sales.
It's a point well made. Why do we keep asking it then, Poonam? Why does it keep coming up?
You could argue, is Amazon being rewarded for each of its flourishing segments?
Poonam Goyal, great to catch up with you.
Theory.
Thank you. You have a theory, Lisa?
Yeah.
Go on.
It's an antitrust play. I mean, how much do you start to get concerned that Amazon gets a lot of income from another strategy that then allows them to lower prices in ways that knocks others out of the park? I mean, that now knocks other retailers out of the playing field. I mean, this is one argument that has pushed the antitrust concerns that seem to be shrugged off every year.
So cynical. But, it makes sense. I'm with you.
You're going to tell me that I'm cynical?
I'm not cynical.
Oh, yeah.
Are you really?
Rainbows and unicorns.
Absolutely. Amazon up by 11.1%. Let's talk about this bond market. Yields look like this on 10s. Down a basis point on a 10-year to 181.67.
That was me dozing off there. For those you in radio, they just showed me on TV just listening to the gloom.
TK, did we fall out and I don't know about it?
Oh, no.
Something happened here.
The week this has been a really strange week for our listeners and viewers. It's the oddest jobs day in ages. I mean, I'm sorry. Gas and oil, where it is a bigger story than this jobs day.
It's going to be very interesting to catch up with the White House later.
Yeah.
Most people just got one eye, if not two, on CPI next week, Lisa. Looking through this, so we've established that for many people, they believe you should ignore the payrolls number at 8:30 Eastern. The difficult part of being part of a market sometimes is the should is not quite the same as the will. Will we ignore that number at 8:30 Eastern.
Given how volatile the market has been, I can't imagine that we will. And I imagine that wages have a greater chance of moving the market, even if they are really noisy, as Cara Gadana was saying. I don't understand actually why the bond market isn't moving more in the U.S. in the heels of what happened in Europe, why there isn't a more sort of tandem trade here if central banks globally are moving a lot faster than people previously
Do you think that's because we've
expected.
done so much work already year to date in the Treasury market and Italy catching up in a bigger way?
Maybe, but you have to imagine, everyone was talking about the backdrop of negative yielding debt being this weight on yields, keeping them lower, and suddenly we have the smallest pool of negative yielding debt going back to 2018. Does this, or 2016 in some cases, does this change the conversation?
We've got to wake Tom up, so let's do that. Coming up next, Priya Misra of TD, and TD believes that at 8:30 Eastern, the number could be negative 200K. That conversation coming up in 5 minutes from New York City on its Payrolls Friday. This is Bloomberg.
Almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
think the frothier areas of the market will continue to have headwinds.
Inflation in the wage costs. We're talking about inflation in materials, inflation in logistics.
The reality is inflation hurts, unemployment hurts.
Where did all the workers go? And are they ever coming back?
We've had this narrative of fire and ice, and we think it's going to be icier.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Payrolls 90 minutes away from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures on the S&P negative 0.25%. TK, the number, you know it well now, 125 for this payrolls morning.
Positive 125,000. John, I believe there's a number that's never been a greater fiction than that number. It's a movable feast south because of Omicron.
And Tom, we've got no idea if it has a positive sign or a minus sign in front of it. That just goes to show how unpredictable this morning actually is.
Well, I like where Lisa is on this. Let's look at the other data. We look at the data, we go beneath the headline data, as I've said for years. But today, you've got to look at wages because on this jobs day, John, I'm looking at one number on the Bloomberg terminal. That may be out to a new high, 92.84 on Brent crude. That's a wow statistic.
I like where Lisa is by just saying, let's look at the other central bank, the ECB. Lisa, that's where the big pivot has come, the more recent pivot in the last week.
Yeah, and I'm surprised that the U.S. market hasn't reacted more, considering the fact that we've talked about the global negative yielding backdrop as being one of the main drivers, the main reasons why yields have remained so low. That is shifting, at least based on market expectations, yet we are not seeing an additional sea change in U.S. yields.
Italian yields up another 7 basis points after a monster move, 21 in yesterday's session. Tom, we need to talk about Amazon, which is positive 11% or so. The Nasdaq 100 up 1/3%. And we've got to go back to crude. Tom, WTI with a 92 handle in America.
Well,
it's been
John,
a monster move here today.
You're behind by 10 minutes because you're worried about opening the show. 92.96 on crude. We're about ready to print a 93 moments ago. This has all happened, folks, in the last 2 minutes. And the answer is
up again
oil's
for you so
on
we
a
can
move.
Discuss it a little bit more, Tom.
Yeah, well,
what did I do to you this morning?
93
Team
is
brought
not
down the
90.
coffee as always. What's wrong?
Look, the car I have takes premium. I mean,
Was it bumpy?
No, premium gas.
Premium gas.
Yeah,
Okay.
fancy gas.
All right.
And,
not premium people.
And fancy gas is going to be $5 a gallon by Tuesday.
And you're upset about that?
I'm upset about it.
All right.
Happy jobs day.
What is going on?
Let's look at those markets.
Tom, I like you. It's okay. We're still friends. Nasdaq 100 futures up 58, up 0.4%. On the S&P, we're down 1/10%. Did not predict this morning, Lisa. Just a bit of a domestic with Tom. Yields come in 2 basis points on 10s.
Is that what they call it in Britain?
They call it domestic. You don't call it domestic, Tom. Is that a British term?
I
didn't realise that was a British term. Okay. Crude, Lisa. Back to crude for a third time. 92 on
bit
WTI.
of a domestic.
Yeah, we're going to have a domestic over the payrolls report at 8:30 a.m., which I believe Priya Bisra thinks isn't going to matter. Neither does anybody else, but we're going to talk about it. We're going to look beneath the headline at the participation rate of whether it continues to increase based on the continued suppression based on pre-pandemic norms. And then, of course, the wages. I'm really focused on wages. Kara Kadana says that doesn't matter either because it's really noisy. They are expected to surge not only because there is a smaller pool of workers that are able to go into the workforce, but also compositionally. A lot of the service sector jobs that are lower paid were the ones that were harder to come back and harder to fill, which is a reason why compositionally you may see a bigger pop there. 10:45 a.m. we'll hear from President Biden talking about the January jobs report. How does he dovetail this into some sort of urgency around Build Back Better, given the fact that you have an unemployment rate at about 3.9% and you do have wages increasing as quickly as they are? I am looking for some sort of immigration policy. What's he going to say there? And of course, what's he going to say about gas prices? And today, Vladimir Putin of Russia and Xi Jinping of China are holding their first in-person meeting in more than 2 years at the kickoff of the Winter Olympics in Beijing. This may be one of the biggest points of the Olympics, that basically this cohesion between Russia and China is increasing as they continue to try to preserve the strategic reserves in places like Kazakhstan and Ukraine. Kazakhstan also supplying a lot of uranium, and so China trying to solidify some of their natural resources as we continue with this green revolution, John.
Lisa, thank you. Looking forward to the events through this morning and into the weekend. Priya Misra joins us now, the head of global race strategy at TD Securities. Priya joined us just before this hour started and said, happy payrolls Friday, that does not matter. Priya, why does the payrolls report at 8:30 not matter this morning?
It's all Omicron related, so we think it's going to be distorted right from wages, work week, participation, and the headline number is going to be impacted by Omicron. So that's part of it. Omicron seems to have surged in some parts of the world, in some parts of the US. But the other aspect is, even though this Fed is embarking on a hiking cycle without forward guidance, they've pretty much given us forward guidance for the next meeting. So they've already told us that they're likely to hike in March. Market's well priced for that. So I'm not sure that a distorted number because of Omicron that the Fed is looking through will actually matter much for market pricing. You know, it's going to come down to other things. It's going to come down to equities, Russia. I would think global rates much more. Yes,
our heads are spinning. I mean, it's been just an extraordinary week of news flow, whether it's Facebook and Amazon and everything else. What is the relationship you're focused on in your world for the next 6 weeks or 8 weeks? Is it a certain spread? Is it 5 year, 5 years? What's the thing that you study first every morning?
So we look at a bunch of things, but you're asking me about one thing, it's 10-year real rates. I would look at long-term, or you can look at 5-year real rates. It's the real rate component as that rises. And I think this is where the Fed is telling us they're going to make that go up. The speed of it, the magnitude of it, I think that will depend on obviously other factors. But if those rise higher, and we expect them to rise higher, in fact, I think what the ECB and the Bank of England did is going to make those real rates go up. That's negative for financial conditions. So, you know, and we've seen that move up this week as well.
Priya, why has there not been a bigger reaction in U.S. markets to what happened over the ECB and the pivot?
I am surprised by that, frankly, because I do think global rates matter a lot for the US. What we call term premium, which is this demand for treasuries that comes from the rest of the world as well as domestic. It is in the global context. If global rates are rising, I would say that there should be less demand for US treasuries. Here's why I think it's not rising. It's this fear that the Fed is going to overdo it, that inflation is going to force them, you know, all the talk around 50 basis points. I think it's lowering the terminal rate. So even if term premium is going up, if I think that the Fed is going to have to cut rates next year because they've overdone it, that is overshadowing this idea that long-term rates should be higher. So I think if we hear from the Fed, I don't know if you're going to get forward guidance, but if we get this idea of gradual, we heard it from San Fran Fed President Daly, or the idea that they are not behind the curve, that they are going to raise rates in a, I don't want to use measure, a steady pace. I think Chair Powell used that. This idea that they're not behind the curve, if they can get the market to believe that, I think then this inversion in the forward curve that we're noticing, which is the market already pricing in the end of the hiking cycle next year, I think as that goes away, longer term rates should start to rise.
Priya, how difficult is it to get a narrative from this market, given how much things are reacting or not reacting to different variables, whether it's the expectation that you have that this jobs report won't matter, but that people will respond to the wage increase that we're expected to get, whereas we're not getting necessarily that kind of signal from the ECB. Is this a lack of liquidity sending a lack of signal?
I think absolutely. I think compared to the last hiking cycle or the one before that, there's market microstructure in the, I would say, fixed income as well as probably the global market, but certainly in the fixed income market, there's less liquidity. We saw this in March 2020. It's a lot of talk of reform, but actually nothing's happened. So yeah, we're looking at less dealer risk appetite. And we've had a significant run up in all assets. So as we're seeing, big positioning shifts, I think we'll overdo moves in both directions. And we're entering a hiking cycle with balance sheet runoff. And the Fed is telling us they're going to be nimble and humble. So, there's no forward guidance, there's less liquid markets. So I think we have to all sort of fasten our seatbelts. It's going to be a volatile ride.
And Priya, when does this crude market become a problem? Are we there now? 93 on Brent, 92.27 on WTI. Are we there now?
I think we're then, I think the market's pricing in this risk of further Russia, but it's even beyond just Russia, Ukraine. It's also the longer term ESG initiative. I think as we're turning more green, we're going to have to live with higher oil prices. How does that fiscal drag Fed hikes? So you can tell why the market's concerned about, growth next year, because you've got a bunch of things going against the consumer and we've got the pile of savings. But is that homogeneously distributed? We think it's not. So I would argue that is one downside risk for the consumer that certainly we're already watching.
Priya, awesome. As always, Priya Misra of TD Securities on this payrolls report today that does not matter. in the eyes of TD. TD looking for negative 200,000 at 8:30 Eastern time. This move in crude, TK, let's talk about it. 92, 99 on Brent.
We've got a long-term chart here, and it's important, John, to go back to 2010, 2014. It wasn't $100 a barrel. The stasis there was about $110 a barrel, and we're legging up there as we have once before in about 2018, 19. But it's got a life of its own, doesn't it?
I remember the tickers still, Tom, on the Bloomberg for the rig count, Bake Oil. Go back to that and stretch it all the way back to 2013, 14, and you'll see the rig count grow quite aggressively as we started to see oil prices pick up to the back end of 2014. Then, Tom, what happened? The Saudis flushed everyone out, and we never really recovered in a big way, did we? We never got back to where we were.
Yeah, this brings up a point. I'm not a big fan of the rig count dance, John, but I will say it shows the angst out there, and maybe what you're going to hear, particularly from Republicans today, which is where's American oil to come on with new supply. And that's one of the undercurrents here. Javier Blas with us, world class in 30 minutes. That works.
Really looking forward to that, Lisa. Just the reluctance to bring new crude back online.
And actually, we're going to get that rig count today at 1 p.m. And the expectation is for it to increase. But why it hasn't increased faster at a time when you do have this dearth of supply, will there be a push to, even in the meantime, in the intermediary between this transition, try to get more involved?
Do we get an auction today? I mean, I'm missing the auction talk.
You missed the auctions.
I'll call you over the weekend. I'll give you tons of auction
I knew that Lisa knew what time the rig count was coming out today.
You've got to put in a rounded
Because I know what Lisa does on a Friday afternoon. And on a Thursday at 4:30 for the balance sheet, right?
Yeah.
Great life.
Lisa, this is the rest of the show. Just you and I talking to each other and no idea what Tom's up to in there. Futures down 1/10% on the S&P. Crude with a move. 92.15 on WTI. On Brent, 92.90 with a brief break of 93. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Amazon is giving the market back some of what Meta Platforms took away. The e-commerce giant is poised to add almost $200 billion in the market value. If the stock's gain in the pre-market holds to Friday's close, that would be the biggest single-day gain in the U.S. stock market history. Amazon reported cloud sales that beat estimates, plus it raised the price of Amazon Prime subscriptions. In the UK, the crisis engulfing Prime Minister Boris Johnson's government has gotten worse. 4 top aides have resigned in the wake of the Partygate scandal. Perhaps the most damaging was the departure of longtime ally Munira Mirza. She quit over what she called a scurrilous remark Johnson made about opposition leader Keir Starmer. In Germany, a third straight day of record coronavirus infections. Europe's largest economy reported almost 249,000 new cases today. The 7-day incidence rate, which has been climbing steadily since the start of the new year, also set a new mark. And the average price of gasoline in the U.S. is now at its highest since 2014, according to AAA. Regular gasoline rose $3.43 a gallon. It's a challenge to President Biden, who has been trying to combat surging fuel prices. Oil prices have been rising amid signs that demand is surpassing the market's expectations. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Today, our first look at 2022 jobs.
I don't know anyone that forecasts unemployment to fall as quickly as it has.
Count on Bloomberg to get you the numbers and analysis you need fast.
The economy has created millions of jobs. We just can't fill them.
Finding people. It's the #1 challenge.
If we have a softening economy that takes the pressure off the Fed.
And what does it mean? It means inflation.
The January Jobs Report. Everything you need right here on Bloomberg Television and Radio.
Inflation remains well above our longer-run goal of 2%. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. These problems have been larger and longer lasting than anticipated.
Powell, we have a problem for the chairman of the Federal Reserve. Lisa making me laugh in the commercial break. Futures down 6 on the S&P.
We didn't talk in the break.
The Nasdaq 100. Actually, we didn't. We didn't. You and I did not talk in the commercial break. All 7 minutes of it. The Nasdaq 100 up 57, up 0.4%. Don't get me going, Tom. Yields in a basis point. TK 181 on 10s.
There we are. It's Jobs Day, folks. I'll pick it up from here. What you need to know, there's only one statistic in the data check that matters today. And across this nation, it's $92.83 Brent crude with a 92 print. We're going to spend a good amount of time in the next 30 minutes on this. Javier Blas will join us. This will be must-watch for Global Wall Street, and particularly those of you across the Middle East working out of our Dubai shop. And right now, we get started strong with Anne-Marie Hordern, who has had uncountable breakfasts at Cafe Frida in Vienna. The breakfasts in Vienna are like legendary, right?
Yeah, they are. I like the Hotel Kempinski.
Well, yeah, so does your Amex card. Redo, keeper of the Amex, has noted your breakfast at the Hotel Kempinski.
So does the whole OPEC Plus team.
We got to rip up the script here. And this goes to her tenure in Europe, gallivanting around, as Joe Coy would say, in OPEC Plus. Describe the power of Russia this morning on a gallon of gas in America.
Well, these numbers, when you look at Brent and WTI, are going to be welcomed in Moscow. President Putin has a budget for Russia that is about $40–45 for Brent. This gets to the heart of actually what the issues were always in OPEC Plus, Moscow and Riyadh. Riyadh, the IMF says needs closer to $90 on Brent. Moscow, these are, especially when you transfer to rubles, even though the ruble is weak right now, these are great numbers for the oil market. It's also a difficult position for the United States. This could not be one of the worst times to have attention.
Does he have power to drive the price of oil higher in America? Not Riyadh,
Of
but
course,
Mr. Putin.
geopolitical risk is why we are also seeing oil prices higher. It's an incredibly tight market, and part of that is people pricing in geopolitical risk. If Russia was to invade Ukraine, they are one of the biggest suppliers and exporters in the world. Of course, they have a handle on this. Natural gas as well.
Anne-Marie, how much will the shale patch become a voting issue, especially as Joe Manchin really presses the administration on this point?
Well, I think it comes down to the price of gasoline. What you're seeing today, that is the highest since 2014. This is how people vote, right? They're not thinking of what's President Putin's handle on the oil market or Riyadh or even exactly what the numbers are. It's what they feel. How do you feel today? Are you better off today than you were last year? Are you paying higher at the gas pump? Are you paying higher for your grocery bills? So this is going to be a problem, especially as we go into that inflation data next week, which most banks are saying is going to be north of 7%.
So how does Joe Biden feel about today's labor market report? How is he going to dovetail this with the cost of living that's increasing and the wage increase that we're expecting to see in today's numbers?
Listen, the administration has already come out signposting that today is going to be ugly. They're going to say it's confusing because of COVID and what happened with Omicron. You just had Priya Misran basically saying the same thing. It's kind of a wash. It doesn't matter this month. What the administration is going to do, because they've been trying to, as you say, dovetail, that there's been a recovery in the labor market, don't focus too much on inflation at the moment. At least we are making progress in the labor market. This is going to be a little bit more challenging to spin for them. But we need to also remember that the president is likely going to come out and talk about his Build Back Better agenda or chunks of it about fighting inflation. He says the American people are on board with him when it comes to things like prescription drug prices, that is a way they can help consumers deal with higher costs.
Peter Bookvar, who writes brilliant notes, just put out a note moments ago, and the headline, and this harkens, John, to what I said yesterday about the 70s, Nixon, Ford, and now Bailey. Now, Governor Bailey's got his own calculus, which John is better at than I am in London. But the answer for Gerald Ford was whip inflation now, and that literally didn't make it to the weekend.
Yeah.
What's the thing they're afraid of if they come up with a plan and the plan fails?
They don't get reelected, right?
It just comes down to the election.
I mean, what is the point of politicians, right? It is to get reelected. And they are going to face really tough midterms. What the Republicans have painted this administration and the Democrats have not been able to do is, and Jonathan has said this, I don't know, countless times, inflation, crime, and education. The president tried to address crime yesterday. Today, he's going to have an inflation problem.
I'm back. I've pulled myself together. Briefly, let's see how long it lasts. Tom, there's a difference between Nixon, Ford, and Bailey. Bailey's an unelected central banker.
Yes.
And Chairman Powell, in the view of many, has let this administration down. Let this administration down by keeping things loose for far too long. Not my opinion, the view of a lot of other people, Tom. So when we look at this situation, I'm often surprised that people come on this show and back up Chairman Powell the way they have done. I was surprised he got a second term from a president that might actually be overseeing a party that gets cleaned out in the midterms over a situation that could have been helped out by a central banker that, Tom, for some people just didn't do his job as well as he could have done.
Yeah, I mean, it's going to be interesting. Well, how will Mr. Johnson? I mean, just Mr. Johnson's a little bit distracted, John.
Well, if Boris Johnson said what Governor Bailey said yesterday, Tom, he would have been in massive trouble for this. This is a central banker. Well, the central banker is saying today, I'm not saying I think is right. I think it's wrong. They clearly haven't done their job over at the Bank of England either. But for the Federal Reserve, Tom, to be sitting here and letting the administration take all the flack for this, I think it's a little rich.
John, we got a lot of lost in translation today. Someone said the next thing we're going to do in the next hour is look at the maroon carpet as they did in the movie years ago. And John, I got to translate this, and I'm just going to put it into the apt phrase you'd see from the Keene household on the weekend. A bit of a domestic. What is a bit of a domestic, John?
Just, an argument that takes place in the house. Domestic.
So, like this weekend, if I have a bit of a domestic over that Balmain,
if you came to mine, and,
that would
an argument.
Be an argument.
This is a domestic. You're doing it.
Yeah. This is the domestic every morning, Anne-Marie, from 6 to 9.
Lisa, can you help me here? I mean, I know you've never had a domestic at the Abramo house.
Never. No, we don't fight. I've never fought before, so I'm just going to hold hands and call Dr. Phil.
I'll tell you what, the controversy guys of an unelected central banker coming out and saying, don't don't ask for a pay rise. Don't ask for a big pay
Well,
rise.
John, okay, let's get ourselves into March.
I'm going to find it
John,
difficult to bury that.
into March, and this is where the Fed hearings going on right now. We've barely touched on this week. What's going to be the bit of a domestic between the White House and the Fed if we get one more month of 7%?
He believes in Chairman Powell, and Chairman Powell can kick things into the right direction, I guess, Tom. I do keep saying the one thing that's on their side at the moment is the calendar. The hope is the base effects kick in the other way, and things improve from there. But yeah, for a lot of people, Chairman Powell has let the administration down on this front. We're still doing QE, Tom.
Yeah, can we talk?
We're still doing QE. We're still doing QE. Yields in a basis point on 10s, 182. From New York, we'll be back in 7 minutes.
We'll talk in the break.
Will we?
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Feel so well rested now after that. Futures look like this morning. Good morning to you all from New York City on TV and radio. Futures unchanged on the S&P, on the Nasdaq 100 up 5 or 6 tenths of 1%. A helping hand today From Amazon, Romain's going to run you through that in just a moment. Let's talk about a move in crude. 7 weeks of gains on WTI. Year to date, up more than 20%. Right now, just short of 93 on Brent. On WTI, 92.13, up by more than 2%. Energy's kicking higher again. And these central banks are starting to move. First the Fed, big pivot. Bank of England goes along for the ride. Then it's the ECB, stepping away from the T word. That's what I want to sit on just for a while longer. Switch at the board and get to this. The German 2-year has been beneath zero, going all the way back to 2014. It's been 6, 7, 8 years, Tom, since we've been above zero on a sustainable basis. And even then, we were dipping and ducking and diving in and around the zero line in the sand on the charts. Right now, on a German 2-year, negative 28 basis points, and yields are up again by 5. The ECB stepping into rate hikes, maybe at the back end of this year. SocGen in that club. I believe Goldman's in that club. Capital Economics is in that club. The changes keep building, keep pouring in.
I wonder about the behavioral construct, John, as we flip to positive rates in Europe. David Folkerts-Landau, among others, has talked about this for years.
It's a massive change, and for a lot of people, for a long time, that German bond market's been like an anchor for the global bond market. A center of gravity, if you will. Euro dollar with a 114 handle, 114.72. Stronger euro in the mix here. And Lisa, you've talked about this. What's happening in Europe, you're not quite sure why we're not seeing this bleed out a little bit more out of Germany, out of Italy specifically, into the rest of the world.
Yeah, this idea that you've been talking about, the anchor that it's provided, sort of the bid into the U.S. Treasury market because yields were so high. They're less high today based on what we're seeing in Europe.
2-year yields creeping up a basis point. On a 2-year, 120.93. In just a moment, we'll catch up with Morgan Stanley. Listen to these estimates. Negative 215K on payrolls. That's what they're looking for in an hour from now. And next week, 7.3% on CPI. We'll touch on that in just a moment. That's across asset price action. Let's get you some single names and say good morning to Romain. Good morning, Romain.
Hey, good morning, John. Of course, as we await that economic data, the focus, of course, still on earnings. Meta Platforms, of course, coming off a phenomenal day yesterday. Phenomenal for all the wrong reasons, losing more than $200 billion in market cap, the single worst decline that we've seen on a valuation basis for any U.S. stock in history. No one's really buying the dip here. The share is higher by about 0.4% here on the day. Maybe that's because a lot of folks are out here buying Amazon. Amazon shares up 12% right now. That adds roughly about $160, $170 billion in market cap to that company should this carry through to this close. That's setting up for what would be one of the biggest valuation gains in U.S. stock market history. And remember, that was a record just broken last week when Apple added about $179 billion in market valuation after its earnings report here. Despite that here, there were actually a lot of red flags in that Amazon report, so it'll be interesting to see how that folds over into the cash open. We should point out, despite the fact that Amazon is up 12%. You mentioned this, John. Futures on the NASDAQ 100 only up about 0.5%, and the S&P futures basically flat on the day. That's because other than Amazon, really nothing of significance right now in those indices is actually moving higher today. You look at the eye-popping numbers on Snap here, up 47%. Well, guess what? That's not in the NASDAQ. It's not in the S&P. Similar story with Bill.com, up 20%. Unity Software, a lot of these names, and Pinterest up 13%, are moving significantly higher, but none of them are in the major indices, so you're not going to see a big read-through into those headline indices. Flip up the board here. Another reason why you're seeing weakness on the S&P this morning is because of Clorox guiding lower here because of supply chain issues, higher costs. Similar story for Ford, which is going to take a little bit longer here to work through some of its supply chain issues. Those shares down about 6% here in the pre-market. And one of the stealth rallies that we've actually been seeing in this market has been with a lot of the energy names. Occidental Petroleum up 1.5% today, setting up, Tom, for a 10th straight day of gains. This, of course, as we look at WTI crude right now, hovering right around $92 a barrel. Brent crude right around 93.
Romain, thank you so much. It is Jobs Day, the oddest of Jobs Days. We're going to rip up the script here with every single guest, and we do that because of inflation. Ellen Zentner, chief U.S. economist at Morgan Stanley, joins now from a plus 200 to a minus 200. Anyone knows what we'll see at 8:30. Ellen, I want to talk about your important research note a number of weeks ago where you said inflation and the ebbing of inflation in March and April is critical. Do you still stand by that call that we will see inflation ebb? Can you do that with $93 oil?
Yeah, absolutely. Because we would be talking about core inflation here. What we're looking for is, not just for inflation to stop moving higher, which we're not at the peak yet, but when we start to get the February data in hand in March, that we would start to come off that peak. And one reason why we've gotten more and more confident in our forecast that will turn later this quarter is that we can see that the inventory building is going on. It's a slow process and it's not super broad-based, but it's going on. Companies are telling us that they're able to build inventories. Companies are telling us that some of those cost pressures are starting to ebb. Now, that does not mean that costs are not still rising, but that they're rising at a slower pace. And that's really what you look for in the inflation data. We're not looking for all-out declines in price levels. We're looking for the growth rate in those price levels to slow. Our global supply chain index turned in the fourth quarter, and that leads CPI by several months. And so every bit of evidence we've gathered tells us that we're going to see that turn, but inflation's still going to remain very high even into the middle of the year. So there's nothing different there in terms of inflation driving the Fed's intent to start raising rates.
So, Ellen, you're at 7.3 for next week. Let's talk about this payrolls number, negative 215. Now, on a program like this one, what we often do is we read out the payrolls figure when it drops at 8:30, then we quickly read out the unemployment number. Ellen, outside of our world, I'm not sure how many people actually realize that we're talking about two different surveys that spit out two different numbers. Can you give us a little bit of just a basic 101 clinic on why the household survey is different to, say, the establishment survey, and why you should look maybe at the unemployment rate still and perhaps not payrolls?
Yeah, so we get a lot more detail about what's going on under the hood of the labor market through the household survey. So when households are polled, are you working? Are you not working? If you aren't working, were you looking for a job? And those sorts of things. And you capture a good deal of more information there. And that's where we get other data from as well that are important on the ethnic breakdown, the age group breakdown of the labor market. And so it's a very important survey. We follow the payroll survey, which is businesses like a Morgan Stanley that would report how many people were actually on the payrolls that month. The methodological differences come in the fact that when you go through the survey week for these surveys, for payrolls, it's not just were you on the payroll that week, but did you actually get paid? And that's why when you have natural disasters, when you have things like Omicron, like a variant that comes through, it's more difficult, especially to pick up part-time workers that might not have been at work at that restaurant that week, and so they didn't get paid. And so that's why we're going to have probably a much stronger print for household survey on jobs than the payroll print, which can be put any number behind that negative sign, and we won't be surprised to see it.
Ellen, are we still underestimating just how strong this labor market is, just how tight it is, and how much wage pressure we'll see in the rest of the year?
So, we were certainly underestimating that in the beginning, Lisa. I mean, who would have thought that over the last 6 months, we've seen the unemployment rate drop by 200 basis points? That's unprecedented. Now below 4%. If you were just to take that trend and stretch it forward, well, you're going to be well into a two-handle range on the unemployment rate by the end of this year. It's just unthinkable. What we've really been waiting for is for labor force participation to pick up more strongly. In prime age workers, we're seeing it pick up. We want to see it pick up faster. And for that, health concerns have to recede. One thing that, yeah.
Ellen Zentner there. I think we might have had a technical problem right at the very end there. Ellen Zentner there of Morgan Stanley. Thank you. Thank you very much. Tom, let's talk about this number then. Negative 215, the estimate coming from Morgan Stanley, plus 125, the median. I'm not sure how much value there is in a median estimate on a morning like this morning, Tom, with a range that wide.
I've been guilty of not really covering the headline data. We'll do that with Jim Glassman here, who's got great anecdote about the real fabric of the labor economy. John, I'm going to go to a 3-month moving average. When in doubt, go to a 3-month moving average, and it's still important. I believe we're going to be under a 4% unemployment rate, and there will be people out there saying, a la Lisa's mention of labor participation, this is a fully employed America.
Yeah, Lisa, you've not given up on this jobs report this morning. You think there could be some signal somewhere?
Well, yeah, I think that not only could you see the tightness coming through, the unemployment rate even come down and wages increase much more than expected. I'm curious about the shift, especially as Omicron picked up, in people who did work in service sectors who say, we don't want to do this anymore, who worked in manufacturing and said, we want to work in an office and we want to work from anywhere. And you're seeing those people remain out of the workforce as they transition to another type of job. How does this feature into wage dynamics, right? Does that mean that the service sector is going to see higher wage increases than, say, office jobs eventually?
So the labour market's been described as tight. Some people also describing it as strong. The chairman of the Federal Reserve doing that called it very, very strong. Lisa, I wonder how strong this labour market actually is. If you've got 10, 11 million job openings in America and people aren't filling them, is that a strong labour market?
Yeah, and what's keeping those people out? And I think that that mystery is being solved gradually, but we're not seeing that participation rate go up, which raises a lot of issues about the labor dynamic going forward and where the workers will come from.
We've got to talk about crude this morning as well. If you're just tuning in, we breached 93 on Brent. We're through 92 on WTI. We're up 2 percentage points. Yields are okay at 181.67. We're behaving there, but the backdrop is, Tom, energy prices picking up. Clearly, the outlook for inflation spooked the Bank of England yesterday in a big way. To hear those words from Governor Bailey, I'm not letting that drop. Just unbelievable. Unbelievable.
And what Marcus Ashworth I thought was great on it in London. And then, John, the follow-on to the ECB was just a bombshell.
Just a pivot I didn't expect. I mean, even in the statement, Tom, in the opening statement, when we went through those headlines before the news conference, the T word was still there.
Yeah.
You did not hear that in that news conference.
I think it was very much the German bank stepping in. I think that will be the backstory.
Tom Keene, Lisa Bramett and Jonathan Ferro. Futures unchanged on the S&P. Your NASDAQ up 5 or 0.6%. Amazon's holding in there. Crude up 2% on Brent, 92.88. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Today's U.S. jobs report could be a tricky one. The median estimate in a Bloomberg survey of economists shows a gain of 125,000 jobs in January, but the individual forecasts are all over the map, everywhere from an increase of 250,000 jobs to a loss of 400,000. Because of Omicron, revisions and seasonal factors, White House officials warn the report could be confusing or misleading. In the UK, Labour unions have slammed Bank of England Governor Andrew Bailey, who called on workers to hold off on demanding big pay hikes. Bailey says restraint is needed to help control inflation. One union official called it a sick joke. And it was pointed out that Bailey earns $780,000 a year. That's about 18 times the average earnings. And Hong Kong is coming out with some new steps to fight the coronavirus. Chief Executive Carrie Lam says tightened social distancing rules will be proposed at Tuesday's Executive Council meeting. The vaccine mandate will eventually require 3 shots, and rapid COVID tests will be handed out at all Hong Kong residents. And Norway has named NATO Secretary General Jens Stoltenberg to be the next chief of its central bank. The choice is likely to be controversial because Stoltenberg is a former prime minister who has close ties to Norway's ruling party. The job includes overseeing the country's $1.3 trillion wealth fund that is indeed the world's largest. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the House for business's greatest minds.
The U.S. has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
What I would be sort of wary about if the oil price goes to 100 or higher is that going to make the Fed more hawkish ultimately because they really want to put a stopper in this inflation bottle?
Well, we're close. Let's put it that way. Brian Nick of Nuveen on crude with Lisa Abramowitz, Tom Keene and Jonathan Ferro. Futures up 0.8 on the NASDAQ, on the S&P up a little more than 0.1%. We've got to talk about what's happening in the oil market right now. 92.15 on WTI, 7 weeks of gains. 7 weeks of gains and year-to-date up more than 20%. 92 on WTI, on Brent, just short of 93 after breaching it earlier, Tom, 92.95.
We're going to get to Javier Blas here in a moment here. Really, really extraordinary, perfect time to speak to him. But first, Kriti Gupta on high yield, which is actually a large part of oil debt. Kriti, what do you have today?
Yeah, well, the high yield energy index actually is made up 12% of just, or the high yield index purely made up of 12% energy. So what happens in the oil market has a direct read through into high yield. Now, I'm going to look at high yield spreads here for my chart of the day, especially because at a time when you have WTI prices crossing that $90 a barrel threshold, you are going to see, or you would think that would actually bode well for some of those high yield energy bonds, but actually you're starting to see those spreads widen. Now, yes, high yield is far more price and yield driven than spread driven, but this really kind of points out the idea that the upside, or I should say the risk from the Fed on the high yield market actually outweighs any benefit from the $90 oil price. You can see that with the spread widening. You could also see that in October when you had natural gas prices and the kind of crisis in Europe affect oil prices as well. But for high yield, instead of tightening those spreads, they actually widened it. Once again, it really speaks to the idea that right now, because a lot of these energy companies had already refinanced last year and cleaned up their balance sheet, once again, the upside is really limited.
Kriti, thank you so much. Greatly appreciated. On short notice, with oil at $93 a barrel, Javier Blas joins us with Bloomberg Opinion, but far more, his acclaimed book on hydrocarbons, The World for Sale. Javier, are the Saudis and the Russians on the same page?
I think that they are. I think that they are very happy what they see at the moment on the market. They are producing a lot of oil. The market is about $90, heading towards $100. They're going to make a ton of money. I don't think that there is much disagreement. And if there is any disagreement, you could think that the Saudis perhaps, the Russians perhaps are more worried about the response on shale. But at the moment, Russia is really struggling to increase production. So I don't see Russia putting any pressure whatsoever on Saudi Arabia to rush more barrels into the market.
$5 a gallon gas, when we get there soon, will be something to behold. Can America turn on the supply effort?
Yes, America is actually drilling a lot, and I think that shale may surprise to the upside this year, but potentially it's not going to be enough, because the main problem on the oil market, it is not on the second half of 2022. It is now. Now is when we are beginning to see the shortage. Now is when we are seeing the refiners paying huge premiums over the futures market to secure oil on the physical market. The American oil, the shale production is going to come, but it may be too late to stop this rally.
Javier, a lot of people say that once the Ukraine-Russia conflict gets resolved, oil prices will come back down and come back down quickly. Do you agree?
I think that there is a geopolitical premium, and certainly European refiners are buying precautionary other grades, non-Russian oil, just in case that there is trouble with Russia and Ukraine. But I think that physically the market is tight, and while there may be a premium there for the potential of war in Ukraine, I don't think that it's as large as some people think. Can we go down $5 if everything gets resolved? Sure. But that brings us to the high 80s, and that's not cheap.
All right, so what's the upside surprise? Where is it going to come from that could push oil to that $100, $105?
The surprise to the upside for me has been, and you know that I have been talking about this for a while, is the financial side, is the options market. We have huge layers of call options, about 95, 100, and 105, and then going all the way to 150. We may be in a situation where the Greeks of the market gamma, and we have seen that on the stock market also at other times, but the financial flows may take over, and those options may just push prices well above $100. If we move significantly higher than $100, I think it's going to be mostly on Wall Street financial flows.
Javier, just quickly, and we can sit on this if you like. Typically, when you get up to these levels, especially over the last 20 years or so, something breaks, something gives way. Last time around, it was the Saudis, just in terms of a market share war that they started at the back end of 2014. You've talked to me about why that could be different this time around, because shale is so less responsive at the moment. Javier, I just wonder from your perspective then where you're focused, what you would expect to break as crude starts to shift out higher. Is it a demand story? What would you say it is?
I think that the White House breaks and makes the phone call. Biden gets into the phone with Saudi Arabia Crown Prince Mohammed bin Salman, someone that he has refused to talk on the phone or meet face-to-face, and he asks for more oil. I think that the White House breaks, and then we get the Saudi response and we get more Saudi barrels.
Javier, are you saying that at the moment what we're seeing in the oil market, not all of it, but some of it, is a blinking contest between this White House and Riyadh? The fact that this president does not want to deal with the Crown Prince?
Absolutely. Biden is refusing to make the phone call. The Saudis want that phone call. They want to be the recognition that they think they deserve, and the Americans, they think that they don't. And I think that it's a bit of it's a okay corral, and we'll see who blinks first.
Javier, what's the power of Mr. Putin then right now?
Oh, Mr. Putin sits on a lot of power. It just produced 11 million barrels a day. So he has a very significant geopolitical tool in his oil exports and his gas exports. But I don't think that Putin is going to use that geopolitical tool, because for him it's more valuable just threatening to use than actually going ahead with the use.
Javier Blas of Bloomberg Opinion now. Javier, fantastic. Lucky to have him with us. Tom, Javier Blas, one of the best journalists in the commodity market on the planet.
Yeah, you got to see him in Davos.
That blinking contest between this White House and Riyadh right now.
Yeah.
That's some high-stakes stuff.
Yeah, when Javier Blas, folks, just to give you a vignette into the Bloomberg world here, when he walks into a room in Davos, there's all these very important people around there. And what's important is they're ignored by everybody else talking to Javier. And then you realize the very important people are talking to Javier. That's the layers here of his knowledge.
Are you saying that when you hang out with Javier, you just stay tight to him, stay close, Tom, so you can get to meet
He and I
people?
shut the piano bar down, I think, like 4 times, you know.
You did a lock-in? in Davos.
Yeah, well, you know.
Yeah.
You know.
Nice. Okay. Lisa, back to the topic of the day.
I was about to say.
Crude, I know. I mean, Tom was falling asleep earlier.
Well, no,
Don't want you to drift off.
I wasn't falling asleep. I actually still am thinking about what Javier Blas said about President Biden making a call to Riyadh and how if he actually gave Mohammed bin Salman a little bit more recognition, that they might actually cater a little bit more to the concern about oil prices. I still wonder how much control they have at a time when OPEC Plus isn't able to produce as much as they're saying they want to.
When did you make the call? 93? 94? 95?
I'm not his oil minister.
They were starting to call around people to put some crude out there, out of reserves, Tom, at the back end of, what was it, November?
John, on the break.
Where we were in November.
On the break, John, when you and I don't talk to each other, I will do an inflation-adjusted oil study that'll suggest where Mr. Biden will make the.
That'll keep them coming for more, Tom.
Yeah.
7 minutes. Go for it.
Looking forward to it.
I thought it's 8 here.
Nadia Lovell of UBS joining us. We've got to pull it together. We've got to pay payroll
we got
at 8:30. Seriously.
We've never done this before.
I'm always... what, TV and radio?
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modelizaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think the frothier areas of the market will continue to have headwinds.
Inflation in the wage costs. We're talking about inflation in materials, inflation in logistics.
The reality is inflation hurts, unemployment hurts.
Where did all the workers go? And are they ever coming back?
We've had this narrative of fire and ice, and we think it's going to be icier.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It is Jobs Day on radio, on television. We'll go beneath the headline data here in 30 minutes. John, the oddest of odd labor reports.
Oh, without a doubt. Big labor report. Could be a wild number. No one's really paying much attention to it because of Omicron. 125 is the estimate. 400K negative is the low. The high is 250. Then on to CPI next week. CPI next week, most people expect it's going to have a 7 handle again. 7.3% is the median estimate. And Tom, given where crude is right now, when does this stop? It feels like we're reaching a tipping point with this conversation. We have gone from inflation shock to potentially a rate shock, and to Bank of America's point, maybe in the near to medium term, we're going to be talking about a growth shock too.
Adjustments over the weekend, including adjusting to what John Farrow is going to talk to Secretary Walsh about, I believe, in the 9 o'clock hour. John, I just did the math on the old above $100 a barrel, $108 a barrel roughly, and that new price, inflation adjusted, is in the vicinity of $119 and $120 a barrel. You know, we're not that far away from that at $93 Brent crude.
We've got a cost of living crisis, Tom. Even with the economy growing as quickly as it's growing. The administration keeps pointing to that. Look at unemployment. It's really low. Look at growth. It's been fantastic. And then we all say, well, okay, look at consumer sentiment. How do they feel? And consumers in America don't feel that great. And they don't feel that great because inflation's got a 7 handle, crude's at 92, and wages haven't been keeping up.
And what's interesting here, folks, is the backdrop. Jim Glassman's giving us some of the fabric here of business across his J.P. Morgan world. And Lisa, it goes to the heart of the matter for you, which is labor non-participation.
Yeah, that it's a tight market because people are not coming back into the labor market because they're retiring or because they're shifting jobs, or going back to school, or taking care of people who are sick. What's interesting is that all morning we're going to be saying this labor report doesn't matter, the number doesn't matter. It's going to come out at 8:30. Wages are going to be really hot. The markets are going to sell off. You're going to see rates, yields go up significantly, and all of a sudden people are going to say it matters. We're going to have to pick the narrative on a highly illiquid market right now that's very reactive without a sense of a compass of where the Fed is exactly going, Tom.
John, what's the data on the screen that matters to the leader of the Bank of England and the leader of the European Central Bank after yesterday's history?
Apparently wages. Wages seem to be the big issue at the moment. The Bank of England governor was essentially asked, Tom, whether he's saying that people in the UK shouldn't ask for a big pay rise. And the Bank of England governor basically said yes, Tom. And you can go back and listen to the interview. Tom, that is just remarkable stuff to hear from the governor of the Bank of England. And that tells you that the Bank of England is spooked. I think the ECB is spooked. President Lagarde, I have to say, Tom, watching these news conferences with these central bankers, so often you get to know them and you get to understand when they feel good, confident, have some conviction about the message, and when they're starting to crumble. And I have to say, listening to President Lagarde yesterday, that message was crumbling and crumbling fast.
And as you mentioned earlier, it crumbled from the initial headlines, including the T-word transitory, out to something that we heard and the market heard differently. A lot of adjustments in euro statistics today. John, let's get through the data here quickly. I'm just going to gloss on oil, 92.80 on Brent crude.
I mean, where do you want to start? So we've got futures a little bit higher on the S&P by a little more than 1/10%.
Noise.
Big weighting on Amazon, I know. I don't know if you think Amazon's
noise. Seriously, it's
we'll talk
noise.
about that in a moment. And Nasdaq 100 futures up 0.8 of 1%. Interestingly, in the Treasury market, yields coming in 8 basis point on 10s to, let's call it 182. Flip over to Germany, and you've got some interesting moves here on the German curve, up 5 basis points to the front end to -30. Just doing this in real time on my Bloomberg terminal, flipping over to Italy and having a look at BTPs. We're up another 12 basis points on an Italian 2-year. On 10s up another 7. We had a 20 basis point move yesterday, Tom. We started this week in the 120s on the Italian 10-year. We're finishing this week in the 170s. big adjustment in the European bond market as the ECB tees up a move, Tom, maybe in the back half of this year.
It was a really interesting hour ahead here. Jeff Rosenberg to join us with BlackRock, and we've got some really good perspective on fixed income and, of course, the economics of the moment in the nation's labor economy. We will take an equity moment here, and we do it with Nadia Lovell, the senior U.S. equity strategist at UBS, joining us this morning. Nadia, I want to go to the reality of the supremacy of technology, whether we see it in Amazon, Apple, Microsoft, or we see it in the application of technology by UPS earlier this week. How do you invest for a broad technology future and avoid the present minefields in the equity market?
Yeah, I think that you have to look for those companies with sustainable growth and market opportunities. I mean, we've seen the tech numbers this earnings season been somewhat mixed. We've seen some strong enterprise demand and good numbers from those companies, and the outlook has been good. While we've seen some misses from some of the platform names where user growth and engagement remains challenged. And so I think you want to focus on those companies where business spending is going to be more stronger and shift away from those companies that are having some issues around user growth.
Talk to me a little bit more about pricing power, Nadia. Amazon putting prices up for Prime. The stock's up 12%. Who has pricing power at the moment, and where's that concentrated sector to sector?
Yeah, when you think about pricing power, absolutely. We think that some areas of tech do have pricing power, of course. We also think that obviously some of the energy companies are benefited from that as well. And I think parts of industrials, we haven't seen the flow through yet of those price increases that industrial companies have taken. In fact, we've upgraded industrials because we do expect that to flow through the P&L later this year.
Nadia, we're having a bit of domestic on set of whether this is noise, what we've seen, the $200 billion swings in market values of big tech caps, whether that's noise or whether that's important to take into consideration to include some sort of premium for that volatility. What's your view?
I think that it's important for investors to take pause and reassess their portfolios in this volatile market. A lot of investors have benefited from being in tech for the last few years, but I think that the market narrative is really shifting, and that reassessment process will take some time. But I do think that as we go through a volatile period, there's opportunity to really move up the portfolio in quality, and that's really our message right now to clients, is to use this opportunity and add up in qualities, particularly in some of these tech names that have longer term growth stories behind them.
How fragile is liquidity right now?
With the swings that we have seen in the marketplace, it tells us that liquidity is somewhat fragile. And I think that will take markets some time to work through. But there's a lot of cash on the sideline because people are trying to figure out where to put that incremental dollars. When you have these wide springs on a daily basis, it becomes more difficult to navigate those changes. But when we look out in the months ahead, we do think that the market is going to grind higher. And so we would take advantage to leg into some of those longer term stories.
Yeah, I look, Nadia, at where we are, and a lot of the tone this morning, jobs report and all that, is something's got to give here. So far through this earnings season, do you see a sustainable upper single-digit thrust where the equity market, whether it goes up or down X%, will sustain itself onto a better time?
I think so. Of course, the earnings season has been quite volatile, but when you look at things in aggregate, it hasn't been too bad. It's been quite decent. So the average beat rate has been about 8%. And when you put that into historical context, that's 2 times the average historical beat rates. And so we think at the end of the day, it's earnings that really will drive the market higher. And so when we look at it from that standpoint, over the next 6 months or so, we do think that the market will grind higher, but there will continue to be bouts of volatility.
Nadia, as always, thank you. Nadia Lovell of UBS. Going into this payrolls print in about 20 minutes' time. At the open on Wednesday, Amazon was at 3,100. Right now in the pre-market, exactly where it was at the open on Wednesday. In the pre-market, it's up 11.6%. And the decline yesterday, Lisa, down by 7.8%. Doesn't that just scream a lack of confidence at the moment that There were a ton of people that just didn't want to hold that name going into earnings after the experience of Facebook collapsing, the experience of Netflix as well. That's a real lack of confidence.
It's a lack of conviction, a lack of confidence that suddenly was regained overnight. I mean, this is the shocking aspect. They all piled in after the earnings report, and I really do question, are we seeing the fundamentals shift enough to justify the shifts in valuation to the degree that we have this week?
You're basically asking, is that earnings report from Amazon yesterday worth $150 billion?
Thank you. That's
in the
much more
pre-market,
graceful, yes.
market cap. Is it?
I don't know. Is it? I mean, I guess we'll see. We're seeing right now it fade a little bit ahead of the open. But how do you value the fact that they are trying to charge $20 more per year for a Prime membership? Does that give them $150 billion in market cap?
I spoke to Mark Kiesel earlier this week of PIMCO. Do you know what he said, Tom? We're holding more cash. We're holding more cash because we think this is it. We're going to see more of this, more volatility, more dislocations, and we want to be in a position to take advantage of them.
He saw, my triple leveraged all cash fund.
And he thought, great idea over at PIMCO. That's what he thought.
Jerome Schneider didn't want to admit it to me, but I'm glad you talked to Kiesel and not to me, John.
You feel very, very sensitive today. Tell me, what's wrong?
I'm rattled by the jobs report. I mean, we're 20 minutes away, folks. You got to stay around for this. It's going to be absolutely fascinating.
I talk to you more than I talk to Mark. I don't even know if Mark's awake right now, Tom.
We're having a domestic.
Don't get jealous. It's all right. No idea what's going on. WTI.
Neither does anyone else.
92. Brent pushing 93 earlier. This market's wild. Futures up 0.1%. Brent now 92.77. Big move higher Italian 10-year yields. Not much happening on treasuries. 181.49. Euro stronger as we start to think about rate hikes to the ECB. Euro dollar 114.60. The year so far, anything but boring. From New York City, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. Vladimir Putin and Xi Jinping have closed ranks against the U.S. and its allies on key security issues. The two met in Beijing. They declared there are no limits and no forbidden zones in the friendship between Russia and China. Xi backs Russia's demand for security guarantees from the U.S. and NATO. Russia has endorsed China's policy on Taiwan. Amazon is giving the market back some of what Meta Platforms took away. The e-commerce giant is poised to add almost $200 billion in the market value. And if the stock's gain in the pre-market holds to the close today, that would be the biggest single-day gain in this U.S. stock market history. Amazon reported cloud sales that beat estimates, plus it raised the price of Amazon Prime subscriptions. Hong Kong is coming out with some new steps to fight the coronavirus. Chief Executive Carrie Lam says tightened social distancing rules will be proposed at Tuesday's Executive Council meeting. The vaccine mandate will eventually require 3 shots, and rapid COVID tests will be handed out at all Hong Kong residents. Meanwhile, in Germany, a third straight day of record coronavirus infections. Europe's largest economy reported almost 249,000 new cases today. The 7-day incidence rate, which has been climbing steadily since the start of the year, also set a new mark. And Hertz has named former Goldman Sachs executive Stephen Shaw as its next CEO. Shaw succeeds Mark Fields, who's been the car rental giant's interim CEO since October. Fields will stay on the board of directors. Hertz filed for bankruptcy less than 2 years ago when the falling value of its used cars caused a debt crunch. It went public again in November. Global News 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
It looks to me that the U.S. economy is a very long way away from full employment based upon employment to population rates. There's been a temporary shock going on.
Danny Blanchflower there. Interesting piece of sound from the former Bank of England MPC member. Not sure what's going on this morning. Tom Keane, Lisa Bramett and Jonathan Ferro. Futures up 0.1% on the S&P. There we are. Nasdaq futures up 0.7%. Yields down 2 basis points at 181 on 10s. This market's really interesting today. If you strip out the Nasdaq, the S&P's barely in positive territory.
Yeah.
Take a look at Europe at the moment. Stocks are down hard in Germany by 1.5%. Look at what's happening in the Italian bond market too. I'm just speaking to an investor on the Bloomberg terminal right now, and they are fixated on what's happening in European fixed income. Crude's positive too, up 2% to 92. Without this Amazon move, Tom, and with the Nasdaq where it is, we'd have a very different feel, I think, for a lot of people waking up and just having a look around.
It sums to me in the VIX at a 25.19 is not a 21. It's halfway to that 30 level, which is a benchmark for the Gloom crew. BramoCam keeps there's a little meter on the side of the BramoCam that keeps track of the VIX. 25.19 right now. Jeff Rosenberg is going to join us after the report. We've got Ira Jersey scheduled on fixed income dynamics and on the equity market. Gina Martin-Adams, I believe, scheduled to be with us right now on the fabric of this nation and its labor economy. James Glassman joins us. Jim Glassman, head economist, J.P. Morgan Chase Commercial Banking as well. Jim, we always show up, but we've never showed up for what an odd report. What are you learning in your context with business for Mr. Diamond's Bank?
Well, it won't surprise anybody. The number one issue for everybody is can't find workers, having to pay more for workers. They're very concerned about it. And a lot of people think, is this the making of a new inflation problem, assuming we get these bottlenecks behind us. I think what people are missing is that in the pandemic era, everybody has learned how to do things differently. And the result is they're much more efficient. And if you're more efficient, it's releasing resources that you can use however you want. So I think what's really stunning, I hear the talk at the ground level, but when I step back and I look at what's going on in the U.S., pay is rising much more rapid, twice as fast as it was. Profit margins are also rising. And that tells you we're in the middle of an innovation moment.
Critical question, and this goes to Jim Glassman's decades of work on America's productivity and this new productivity. Jim Glassman, is Amazon and the others, are they simply on a path to $20, $21 an hour?
Probably. I mean, look, everybody has shifted. Everybody's learned that online activity has got a lot of benefits. And so Amazon is this event is accelerating the shift away from brick and mortar to online. And they enjoy, when this kind of thing happens, Amazon just can't keep up with it. So I think that the pandemic is just enhancing their ability to pay more. And workers, and this is why people are competing with Amazon. If your manufacturing operation happens to be near a distribution center, you're competing with Amazon for those workers, and that's helping to drive pay to higher levels.
Jim, perhaps it's driving pay to higher levels, but it also might lead to a participation rate that stays low if you're talking about automation and the productivity from basically eliminating the necessity of some jobs. What's your view on the participation rate in this new productivity wave that you see?
Well, because of the demographics, it's been declining over time, right? But the pandemic threw us off course, and I think what the pandemic did is a transitory thing. Most of the folks who dropped out are, a handful were over 65, but most of them are younger. And when we were providing the support, the federal government support helped people get through it. But now that support is disappearing. So I think we're going to see more and more people coming back. In fact, they are beginning to. We still have about 2 million people who are out there who have left. My guess is over the course of this year, the fact that companies are paying more for workers is an added incentive to get people back in. So I think we'll see a lot of this come back. The problem for the Fed is we're not at maximum employment, but there's uncertainty about how quickly this is going to be happening. And I think the economy has made enough progress that they've really got to get to the sidelines, and that's why we are where we are.
Hey, Jim, forgive me for jumping in. We've got to go. It's good to catch up, sir. Thought you were done. Right. Jim Glassman there of JP Morgan Chase Commercial Banking. Thank you. More calls on the ECB. This from BNP Paribas. The ECB left the door wide open for rate hikes. They now expect 25 basis points in both September and December. A further cumulative 50 basis point hikes of next year, taking the depot rate to positive 50 by the end of 2023. So that's 100 basis points worth in around about, 18 months? Over a period for them of less than that, Tom. At a time when we came into 2022 looking for nothing from the ECB. So we've reset there, and we're resetting in markets in Europe, Tom, in a big way too.
I mean, I know we got to go to the jobs report, but folks, the seismic shift of moving from a negative interest rate regime out to something with a positive statistic on it, this is truly original for international finance.
Are we pushing it too far too quickly in Europe? I don't know, but that market just breaking down a bit, Lisa, on both the equity side and on the fixed income side too.
I just wonder how this translates into the economic trajectory. Right now in credit land, you are seeing credit spreads, the implication widening really significantly. Basically, this is what happened during the taper tantrum of 2013 in the United States, where you saw rates sell off, you saw yields rise on the benchmark rate side, but you also saw that extra cushion to compensate for risk also increase at the same time. How long can this continue before the ECB backtracks?
Are you saying we're getting a tantrum a la 2013, but in Europe this time around, not in the States?
Well, we're not seeing it in the United States. We've seen a contained credit market in the U.S. In Europe right now, there is a move that's particularly significant and is getting people's attention.
Getting our attention too. What is not getting our attention is a number that drops in 6 minutes' time. And Mike McKee, there's good reason for it. We have had guest after guest get freezing cold water, ice cold, and just poured it all over the payrolls report that comes out in 5 minutes. Mike, are you one of those?
Yeah, I was calling this perhaps the most interesting but inconsequential report in years, because there's so many different statistical issues with the January jobs numbers that people will look past it. And we already know what the Fed's going to do, so there really isn't a whole lot of implications for this for traders.
Mike McKee, looking forward to your coverage. In the hot seat, TK, ready to lead us through it. The number drops in. Where are we? 4 minutes away.
Well, we're going to go beneath the headline data. What matters? And I'm with Lisa here, John. I'm sorry. It's about the wage dynamic that we'll see. And I understand Mike will be way better on this than me. But, you know, what I would state, John, is it's 7.3% inflation next week. Real incomes in America are not only negative, but big negative, and have been negative now for a longer and longer time. And that will be front and center with your conversation with the Secretary of Labor.
It's tough to spin. At least in many ways, the payrolls report, if it's a really rough number in 5 minutes, that's easy to spin. But going into next week, 7 handle on inflation. Crude right now, 92. At the pump, prices going higher. It's a difficult moment.
The spin zone's over. It's now, what are they going to do about it? What kind of proposal can they put forward to make their agenda?
We are 4 minutes away. Your payrolls report in America just around the corner. Michael McKee is going to break that down for you. We'll whip through the price action and get the view of Jeff Rosenberg of BlackRock. From New York City, for our audience worldwide, alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Your equity market just about in positive territory on the S&P. The payrolls report drops next.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
10 seconds away from a highly unpredictable jobs report. That jobs number just about to break. Futures up 1/10 on the S&P. On the Nasdaq up 0.8%. Yields come in 2 basis points on 10s to 182. On 2s up 2 basis points to 122. A sell-off in the European debt market as we wait for the attention to shift from Europe and the commentary from ECB President Christine Lagarde to a massive upside surprise here in America. Mike McKee, run me through this one, buddy.
I don't get it either, John. 467,000, and that's a plus sign in front of that number. 467,000 jobs created or restored in January. The unemployment rate does tick up to 4%, but I'm going to guess, I have to look at the details, I'm going to guess that's because more people came back into the labor force. Just an astounding number given the fact that 125 was the forecast, and we had people who were expecting negative 400,000. Let's take a look at some of the numbers here. Unemployment rose for adult men and whites. I'm looking through all the numbers here. Trying to pick out a number.
This has been the biggest miss in history. Mike, take your time and give us three nuggets.
You know, I'm wondering what the folks at ADP are thinking right now. The labor force participation rate, let's tell you that stays at 62.2%, although that had been 61.9. So I think they may have revised that, although it doesn't say that immediately. Average hourly earnings on a month-over-month basis up 0.7%. That's a huge gain after an 0.5 the month before. And we were thinking that number would go up because a lot of people would have lost their jobs in the low-wage industries, but that may not have happened. Pushes average hourly earnings to 5.7% on a year-over-year basis. We have private payrolls up 444,000, and that was expected to be only 35,000. So a rather amazing number today.
Unreal, Mike.
Go ahead and tell us what the markets are doing, John. I'll look at where the breakdown comes.
I said to Bramo coming into the number 500, but I also said negative 500. So we are at 467. Look, the attitude towards this jobs number this morning was basically if it's bad, ignore it, and apparently if it's good, let's go. Yields up at the front end by 7 basis points on a 2-year. We'll see if this move sticks. We haven't been at 127 for quite a while, Tom. We're there now. 10s at 188, so lift there at the back end by 5 basis points. So this curve is just a bit flatter, but the whole curve is shifting higher. US dollar, let's look at that. Euro dollar right now coming back in after a pop earlier. Euro dollar 114.45. Your dollar index 95.48. So they've got a lift there on the US dollar. And TK full steam ahead to next week. CPI in America expected to have a 7 handle.
Well, you mentioned the wage statistic, and what we're doing here, folks, and we can do this with the Bloomberg terminal. We're multitasking. While I talk, John's going to study, Lisa's going to study. I see the 10-year real yield with a vengeance, 4 basis points higher, no surprise there. And the 2s10 spread really hasn't moved yet. The bond market is moving in tandem, if you will, to a new higher real regime. Mike, do you have any wisdom to say here?
I don't know if it's wisdom, but I'm looking at the categories that expanded the most, or the ones that have gotten the most attention. And it does seem, and I don't want to throw a lot of cold water on a really good number. I don't want to ruin Joe Biden's day, but it does seem that a lot of this may be related to seasonals, because this is a month in which all the people who in the past had been hired for the holidays get laid off. But that doesn't seem to have happened this time. Retail trade employment rose by 61,000. General merchandise stores up 29,000, and building material and garden supply stores up 6,000. Transportation and warehousing, everybody got hired couriers because we were all ordering online, but jobs went up 54,000 in January. And then employment in local government education, this is a month where we also see people fall off the rolls there, rose by 29,000 in January. So there's a seasonal component to this that did seem to add some, but that still doesn't add up to 467,000 jobs. Manufacturing jobs were up by only 13,000, which is down from 32,000 the month before. So there's some odd things in here as we expected, but not in the same way that we expected them. We have to mention, too, guys, that this is the month in which they revise a lot of the data for benchmarking, and it does show that we have some changes in that area that people have to, in terms of the overall labor force. It has gone up some. The labor force is 63 million, 687 from 162, 294 in December, and those numbers are not comparable because they add in. So that does affect what happens with the unemployment rate and the participation rate.
This is the game. This is the game, and this is the response from Neil Dutter of Renaissance Macro. This will get your attention, Tom. Here's the quote, and on Twitter. Revisions surged 709,000 over the last 2 months. January beat while expectations were heading south going into the report. The Fed is looking increasingly offside relative to the data flow. You cannot rule out a 50 basis point move at the March FOMC. Not my view, that's Neil Dutter and on Renaissance Macro right now. Tom, you wonder if other economists might follow.
I'm going to say this because there's going to be a lot of heat taken on guys like McKee and frankly Neil Dutter and others that this is an arcane science and they don't know what they're doing. This is really, really difficult to do. We're in a natural disaster. It's all original. John, with the revisions, I've got a 1.1 million job formation statistic, and that's just absolutely extraordinary. John, I want you to bring in Jeffrey Rosenberg as the markets move here, but I really want to rip up the script, John, in the next 30 minutes and leave McKee here to give us further study on the most stunning miss I've ever seen.
That sounds perfect. This is a monster upside surprise. 467 is the number. 125 was the estimate, but the range was huge. 250 at the top end, negative 400K at the bottom end. Wages look fantastic. The 2 years responding. Yields higher there by 9 basis points. We approach 130 on a US 2-year.
John,
Jeff Rosenberg. Yeah, sure. You want to jump in, Mike?
Yeah,
sure.
I just want to jump in with one number here because we didn't even notice this. That 709,000 you're talking about, December was revised up from 199 to 510.
Wow.
There's a note in here that suggests that the seasonal factors have been updated to better distinguish what was COVID and what was seasonal. And so it's not just that there was a huge gain this month, there was a huge gain last month as well.
Let's get to Jeff now from BlackRock. Jeff, we were told to ignore this one. We're not ignoring it now, Jeff. Why?
Well, you can't ignore this one. It's got a lot of moving pieces as we're dissecting here real time. You know, I think Mike's got it right in terms of the revisions is really important. You don't see the expected Omicron impact. A lot of that can be due to the difficulty of seasonal adjustments. But the other pieces of this report are also very strong in terms of the wage piece and the labor force participation rate. So, you know, taken in total, you talked about the market reaction and Neil's comment. You know, this really is not the kind of little bit of we can look past this one, but much more about both what it tells us in terms of those revisions as well as what it's saying today. This is the labor market really screaming, I should say. And that's going to continue to keep the pressure on the Fed. And that's why you're seeing the move in the front end, because the market is pricing this acceleration in near-term tightening. And I think that will remain the theme here for a while. This report does a lot to continue to accelerate that theme of upfronting the pace of Fed hikes. Maybe, you know, I don't know if that's necessarily 50, but it's really about how quickly do they get it in this year, and a very rapid change from, you know, expecting a quarterly pace to now, you know, it's going to be every meeting, to Neil's comment about now they need to throw in a 50 in there. But definitely here, the surprise is that this is just, again, telling us how overheated this labor market is.
Can you put this report together with what we heard from the Bank of England, the European Central Bank, the shift that we have seen this week in markets as globally there is a feeling that the labor market, that in general, inflation is getting too hot? And have you shifted your investment perspective at all?
Well, there's still this distinction, you know, between the U.S., the Bank of England, and the ECB. We heard a lot about that yesterday from Lagarde. But overall, in terms of particularly the outlook, both for all three, the labor market will very much sit at the center of that debate. I think for Europe, that's still, to be seen. I think what you're seeing here in today's report for the U.S., as well as for the Bank of England, is that the strength in the labor markets is really the risk of a more persistent inflationary outcome, because that strong of a labor market is about the fears of wage price spiral. And so it shifts from the supply side COVID disruption narrative to something that's much more difficult for policymakers to rein in, which is a wage price spiral source of inflation.
Jeff Rosenberg, the 10-year inflation-adjusted yield is a measurement of a negative 0.54. This on a day where we really consider finally a positive rate regime across most, if not all, of Europe. I'm going to assume the path from here to a flat or positive 10-year real yield has nonlinearities in it. What's going to be the impact to the overall financial system and to the overall economy is that 10-year real yield migrates up towards zero?
Well, it's a question. In your question, is it a slow migration or is it a nonlinearity? The Fed doesn't like nonlinearities because the market doesn't deal well with nonlinearities. That's too rapid of a tightening on financial conditions. The Fed wants to tighten financial conditions, but it doesn't want to crash confidence and over-tighten. So it's a very tough path for the Fed to try to take. That's the argument against a 50 basis point shock. Because it is a bigger shock. It risks sort of a narrative getting away from the Fed that they're way behind the curve and that inflation is accelerating out of control, whereas in their forecasts and the market consensus forecast is that inflation will start to come down. So you don't want to over-tighten and over-shock the market, yet the path towards real interest rates here globally, and I think that's the message for the week, is that we're going to exit this era of persistent negative real interest rates. The challenge is, can you exit that era without a bigger financial tightening, a bigger financial accident? Clearly, that's what the policymakers are going to be aiming for. And so the guidance around that is going to be to try to tighten without over-tightening.
Jeff, just as an investor at PM at the moment, are you having fun in this market? Is this fun or is this brutal?
Well, it depends on your investment process and what you have for levers. If you have a diversified portfolio across both directional, which is, are we betting on interest rates going up or interest rates going down? That's a very difficult set of tools. But the other thing that's happening here that is quite advantageous to a different toolkit, that is a toolkit that exploits differences across interest rates, differences in dispersion in both micro and macro markets, it's actually starting to become a much better environment for those types of strategies. And so while it's difficult in terms of kind of direction, will markets go up, will markets go down, as the Fed and global central banks pull back from this era of incredible liquidity and policy accommodation that has compressed differences, that reduces opportunity, you actually see opportunities arise in what we call in the cross-section and differences across countries and different companies. So a little bit of glass half empty, glass half full there.
For those of you who think they've been living in the real world for the last 2 months, you haven't been. Omicron did not happen. 467 is the number for January. The previous read, 510. Lisa, this stuff is just unbelievable, just to get your teeth into. We were told repeatedly this morning, ignore the payrolls number, big Omicron impact, and then bang, yields exploding up 8 or 9 basis points to 128. I'll discuss this with Jeff's colleague a little bit later, Rick Reeder of BlackRock, talk to him about how on earth he's handling this situation, just the cash allocation. I wonder how large that is at the moment. Anastasia Amoroso will join in, Mike Collins of PGIM too, and then later we'll catch up at the White House. I imagine, Lisa, the interview that Secretary Walsh thought he was going to do yesterday
It's very different.
It's a different one to the one he's about to do now. I think he was about to tell me all the differences between the household survey and the other survey and why this number was so bad. And This is going to be a different one in about an hour.
It's going to be one about inflation. It's going to be one about a labor market that looks increasingly tight. I keep going back to this idea that the European market right now is really in shock still from the ECB's pivot yesterday. Why has the U.S. market not reacted? It looks like the reaction is coming today. Jeff, do you think that there is more to come in terms of this recalibration of, as what you said is, we are moving to a new regime where negative real rates are no longer?
Yeah, look, I think there's a lot of room to go there. And I think there's a big debate growing around the pace of how quickly the ECB has to move. You know, there's still a lot more, as Lagarde said yesterday, a lot more data dependence. And so you saw the first crack in European inflation data, right? So that's really what has kind of changed the narrative and forced the ECB off of the somewhat conditional promises of no rate hikes. They've been kind of mugged by the data, mugged by the reality that inflation there is rolling. Now, they, again, have a different underlying fundamentals between wages than what we're seeing here in the U.S., and that's partly, Lisa, why I think you saw less of a reaction in the U.S. relative to a very strong reaction. But also look, again, in that cross-section, where was the biggest reaction? Jonathan mentioned it earlier, the spectacular increases in Italian yields, because in the cross-section of European central bank support, it's compressed. It's muted the fundamental differences in where yields should trade across the European complex. And so as you pull back, not only on the level of that interest rate support, you're going to see a lot more in the cross-section. That's going to be a challenge to the ECB, but it is very much part of what I think we're going to see reemerge as the ECB is forced to pull back on this tremendous era of policy accommodation.
Jeff Rosenberg, thank you so much to BlackRock. What a busy day you're going to have at your shop. We welcome all of you on Bloomberg Radio, Bloomberg Television. Lisa Bramlett and Tom Keene, truly an historic set of days. ECB and Bank of England yesterday with their shock, and today the mother of all shocks I've ever seen in the labor economy. Here's what we're going to do. Gina Martin Adams scheduled to be with us on Equities, Ira Jersey in moments, but I want to go to Mike McKee right now on wage inflation. I just did a fancy Bloomberg study. Average hourly earnings, 5.7%. I did a thing called a log extrapolation, and it's supposed to be 3.9%. So we've got a gap, Mike, of what wage inflation is supposed to be versus where it is now. Is that enough for the Fed to really think about March or even a before March meeting?
I think I would have to say no at this point, and at the risk of boring everybody, the reason being is they're going to have to take apart these numbers a little bit more. I've been looking at the revisions that the BLS
give us a window
has done,
into that before you get to Ira.
We had that 709,000 jobs additional from the revisions to November and December, but you go back and you look at what they have revised previously in 2021. The number for June is 405,000 less than it was. The number for July, 402,000 less than it was. So these numbers are kind of offsetting, and perhaps...
Hello traders, how are you doing today? Hope you're doing well. As you can see, we closed really good whole position very profitably. We made 55,000 pounds on euro. We was holding positions for several months, and it's worth it. As you can see, this is how to work out how we do trade. If you want to find out more how we trade, you need to get this strategy. We hedge position, we do arbitrage. This is all information for people who knows how we trade. This is basically all arrows, everything it shows when we hedge and how we made a profit. We sold at the here is stop yellow line at this position, all positions at this line, and we collected profit at 55,850. Right now we have also we opened new position on euro, as you can see, and right now it's time to place stop on for this position. So the price I'm looking to place 114.45. 114.45.6. It will give us 1,000 pounds in profit if it will move, change direction, and if it will move higher. Okay. And let me all change color for new people who want to understand how it works. What color we will change? We'll change to, let's say, the cream color. Okay, guys? So that's it. We secured this level as well. I want to remind you, we trade 1 pip equals 100 pounds, except Bitcoin. With Bitcoin, will be 1% will give us 1,000 pounds with Bitcoin. With other forex pairs, we trade pip equals 100 pounds. Okay, you can trade any margin you like. You can have 30 pounds, you can have 10 pounds, you can have 100 pounds as well if you have enough money on your account. Okay, I'll speak to you later. Today is a really good day, and stay safe. If you want to get the strategy or if you want to register for a webinar, please go to company.co.uk and you will get all necessary information about the events and strategies available through our company. I'll speak to you later, guys.
50, say in June, if you continue to get numbers like this, yes. So I do think that eventually they might do a 50, but I think not as a first move.
Ira Jersey with us with Bloomberg Intelligence. Ira, the chart of the inflation-adjusted 10-year yield is now broken out to a new, lesser negative statistic. That's in itself really, really extraordinary. Up we go, and on radio, all you need to know is we've broken out near 0.5% negative on the 10-year yield. How does that change, rather, the short-term yield space?
Yeah, so you've seen, this big uptick in like you said, 10-year TIPS yields, and now we're right around what our model shows as fair value, around negative 52 basis points. So we're pretty close to that. But it's really that front end, like what's going on in the 2-year real yield and the 5-year real yield, because those were massively negative, and those have come back even faster than the 10-year has. And I think that that's just a sign that the market does think that the Federal Reserve is going to hike. When they start hiking, I think that real yields can continue to sell off significantly. And inflation expectations, longer-term inflation expectations that the market's pricing, might stay exactly where they are. So what that means is that for nominal Treasury yields to move, you just have to watch the TIPS market, and they might start moving almost 1 for 1, which is pretty much what's happening today.
Ira Jersey, thank you so much. The publications out of Fixed Income Bloomberg Intelligence will be something over the weekend. Gina Martin-Adams with us now on the equity side at Bloomberg Intelligence, with years and years of having courage to stay in the market. Gina, how do you stay in this market after the week we've seen?
Well, I think you first take an observation that even after the week we've seen, we're still not even back to testing last week's lows. I think when we look at the grand scheme of things, we are in an environment where the Fed is catching up to reality. Growth is extremely strong, and we're seeing that in the earnings numbers. The vast majority of companies that are reporting earnings are beating expectations, notwithstanding what we saw out of Meta yesterday, or the day before yesterday. Nonetheless, overall, earnings are still growing. They're still growing at a faster than expected pace, and importantly, companies are revising their revenue expectations higher. So we are seeing analyst expectations for revenue improve as the economy is much stronger than anyone had anticipated and continues to be so. The problem really is what's happening with inflation, and we see that in earnings as well. So I look at this as sort of short-term weakness. We probably have that weakness extended as the Fed plays catch-up to economic reality, tries to get inflation somewhat contained. But in the meantime, we're going to have a choppy market. As you know, the scariest number out of the employment report this morning was the average hourly earnings number. I think you mentioned this, Tom. That is a very inflationary number, confirming what has been extremely sticky inflation. And we're seeing that reflected in margin forecasts. And until margin forecasts stabilize, you just won't see stocks reestablish a strong uptrend.
Gina, with this soup that you just put out there, and it is a soup of the Fed and inflation and earnings and fundamental backdrop of the economy. With this soup that you just put out there, and it is a soup of the Fed and inflation and earnings and fundamental backdrop of the economy, how much do people have to bake in a volatility premium, an uncertainty premium, before going in and seeing value in stocks that appear beaten up based on recent trends?
Well, here's where we actually have some cushion, Lisa, because the equity risk premium is abnormally large considering where we are in the economic cycle and how extended this bull market has been. It's not as large as, say, it was obviously in early 2020 or 2009, but it is extremely large relative to history. As a matter of fact, for most of the last decade or so, we've stayed with an equity risk premium that is in the upper quintiles of long-term averages or long-term history. The problem is, how much does the bond market adjust? Because if the bond market continues adjusting, that really depletes the equity risk premium, and we have to see ever much stronger earnings results to keep the equity risk premium somewhat higher. So I think we have actually embedded some degree of risk premium. The problem is the bond market is adjusting as well. And we do need to see earnings sort of offset that adjustment to keep stocks moving higher.
But Gina, everyone's been pointing to the bond market as the source of volatility, as the source of risk right now for equities, with the fundamentals looking pretty good. And then what we saw this week from Meta or Facebook, what we saw from Amazon, at least in the pre-market trading, from Apple, from all of the companies that really, from Alphabet, excuse me, highlights this degree of volatility based on fundamentals that is unprecedented. What do you make of that?
Yeah, I mean, I think that the bigger story is that all of those companies that you just mentioned dramatically beat expectations, except for Meta. And the bigger story there for me, and just like the rest of the S&P 500, is analysts are really struggling to get to capture these moving parts of much, much stronger than expected growth, but also much stronger than expected inflation. Meta, I view as something of an isolated event, really specific to social media, pretty adequately, frankly, forecast when they changed their name to Meta toward the end of last year, suggesting that their business model is under some degree of duress. They're going to refocus efforts going forward. But every other one of those companies dramatically beat expectations. And I think that that's the really big story still for S&P 500 earnings at large, is companies are still just trouncing forecasts. The trouble, if you want to find trouble in earnings, really is regarding inflation. And that's where we see some suppression to the overall economic growth reality.
Gina, I want to cut in here. This is a real sea change moment, folks. A 10-year yield showing the gloom of the pandemic and this natural disaster was a negative 1.00. We are halfway back to zero. We have just breached a negative 0.500. A lot of numbers there. All you need to know is the 10-year inflation-adjusted yield is moving up rapidly towards zero. Gina, is that good for the banks? Is the great missed call here, as a lot of people say the banks, maybe they had their run, they're over, that this is the year for James Dimon, this is the year for Brian Moynihan?
Yeah, I think it's the year for value, absolutely. It's the year for energy as well as financials. We've actually leaned a little bit more on energy as oil prices are also continuing to spike, as we see very strong demand but very limited supply for traditional as well as alternative energy product. But that, I will suggest that financials also are very well positioned in an environment where growth is strong but inflation is also strong and yields are adjusting. The trick for financials is that flattening yield curve. So while we see yields overall moving higher, the yield curve is flattening, and that could be a little bit of a problem for financials. That said, it's not yet. Certainly, we're seeing revenues come in better than expected for the financial space as well. As long as we continue to see strong economic activity, they should be able to overwhelm that flattening yield curve. But they are value stocks. Value does tend to perform best in inflationary conditions like we have today, and in periods in which the Fed is increasing rates to catch up to inflation.
I don't have time to get this up on a banner. Gina Martin Adams, thank you so much. Get back to work. The equity market's going to be nuts over the weekend. The publication, Lisa, this weekend by pros like Martin Adams in Jersey and everybody else is just going to be absolutely stunning. Lisa, on the 2-10 spread, the difference in yield between the 2-year and the 10-year, we're right now at 61 basis points, 0.61 percentage points. And that mark, Lisa, as we just showed, the 10-year yield equivalent is 57.08. We're not there yet to an ever flatter vanilla curve.
Yeah, although you are seeing that with the gap between other yield spaces like 7-year and 10-year, which is something people have been watching for a potential curve inversion, less than 3 basis points separating those two denominations. I want to go back to something that Jeff Rosenberg said, and I think that this really goes to the poignant chart that you showed as far as negative real yields. We are moving to a regime where negative real yields will no longer be the normal. That is Jeff Rosenberg of BlackRock's view, that the Fed, the other central banks are moving away. This sea change has unpredictable consequences on markets, and to try to get your hands around them really speaks to that noise or those huge swings that we've seen this week.
I would say an historic day, but I'm not telling the truth. It's been an historic 48 hours from London to Frankfurt. Thank you, Manus Cranny, for coverage from Frankfurt yesterday. And all I can say is today, stunning. Stay with us on radio, on television. This is Bloomberg.
Do you remember when everybody told you to ignore it? They're not ignoring it now. A monster upside surprise on the payrolls report. Yields higher, stocks lower on the S&P and on the NASDAQ too. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York City, we begin with the big issue, a totally unpredictable payrolls report.
The January number, payrolls numbers, non-farm payrolls data.
Don't see the expected Omicron impact.
The question is it just an Omicron, kind of final pare back and hiring?
The labor market is extremely tight.
Or is it something bigger?
You've just seen the biggest sick out of your entire life, your entire career. That's all that is.
I don't think the number is going to mean too much.
We're going to ignore it the best we can.
One of the most difficult environments for the Fed to face.
With regard to the Fed, I'm not sure where I stand.
They're going to have to be very careful, in these rate hikes.
We're talking about 5.
We're at a turning point.
And 6 and 7 hikes. It's a little odd.
This report does a lot to continue to accelerate that theme of upfronting the pace of Fed hikes.
Well, they're not ignoring that number now. BlackRock's Rick Reeder joins us to discuss. Rick, let's talk about it. What a monster upside surprise.
I mean, it's pretty impressive, Jonathan. I mean, it's not just, every single part of this number was solid. I mean, it wasn't just the number of jobs, and across, by the way, every industry, virtually every industry. Construction was a little bit softer, but everything else was strong. The number of people, the household survey was tremendously strong. And then the wages data, I mean, boy, it couldn't be any more clear around you need to pay more to get people on board. You're starting to see people come on board. You're starting to see people, which I think is durable, will come into the labor force. But you got to pay for it, and you got to pay for it depending on the industry you're in. You've got to pay for it more dearly, and you're seeing that work through the numbers. But this was an impressive report. I have to say, you would have thought with Omicron, you wouldn't have been able to get as many people on board. But pretty darn impressive. I tell you, it's a bit mind blowing.
What do you say to people who have listened to this show and others all week? Full of people saying, ignore this number, ignore this number. Why should they pay attention to it now?
I think if the number was weak and it was soft, then you would have given credence to the idea that people were going to wait another month before going back to work. Employers were going to have a hard time and they were going to take a bit of time. But you can't ignore this number. I mean, by the way, not just this number, the revision. And this puts... By the way, in a week where you saw the ECB and the Bank of England, listen, there should be no ambiguity. The environment is one of tightening policy, and this number gives it another kick in the back in terms of moving forward.
Well, let's get to the money question. Neil Dutzer of Renaissance Macro reacted to this almost immediately, and he said the following. Revisions surged 709,000 over the last 2 months. January beat while expectations were heading south coming into the report. And here's the line. The Fed is looking increasingly offside relative to the data. You cannot rule out a 50 basis point move at the March FOMC. Now, Rick, the Fed speak we've had going into this number doesn't jive well with that. I wonder what the Fed speak's going to sound like coming out of it, going into CPI next week.
Yeah, I mean, I would have said there was a 0% chance of 50 basis points. I still think that is still a lower probability. But it's definitely brought it onto the table. By the way, the one that it's brought onto the table, the most ironic, the most crazy dynamic. We've got 5 more weeks of QE going in. That should be cut off. And I mean,
Rick, sit there. Let's not run away from that line. That's so important. Rick, here we are, looking at next week. A 7 handle again on inflation, widely expected. 467 on payrolls this month, 510 the previous month. And Rick, they're still doing QE.
I mean, it makes no sense. I mean, they should. I mean, quite frankly, they should just end it. And I think, I mean, as opposed to going 50 basis points, because, you know, some of the data that you've gotten this month has shown some moderation, not today's, but some of the data has shown some moderation. You've seen some inventory build in some places. You've seen some of the surveys showing some back off a little bit. So listen, they got to start moving. They've got to stop easing and through the balance sheet channel. And but listen, you know, do you go 50? Listen, I think one thing that was really important to the Fed is the Bank of England and the ECB just made their job a bit easier. So, you know, you think about, you know, how do you keep, you don't want rates to move that dramatically high, but, you know, you've got other central banks moving, then I think you've got a window, and I think the Fed's going to take advantage of it. I mean, it's pretty clear. I mean, there was no ambiguity from Powell at his last press conference.
Yeah.
And, you know, certainly you got to go. But, you know, the fact that liquidity is going in today, that should be shut off.
If you're just tuning in, 467, the number on payrolls with a positive sign. Some people thought maybe a negative sign. Mike McKee, when I went across the mic a little bit earlier this morning, Mike just laughed. Mike, have you ever seen a number like this one relative to what people expected?
I don't know if I've seen one relative to what people expected like this. However, I'm a little less excited about it than when you first saw me reporting this number, because it looks like this report is a statistical mess. Let's take a look at the headline numbers that got everyone's attention. 510,000 jobs was the revision to December, 467,000 when we thought we were going to get 125,000. The unemployment rate ticks up, the participation rate jumps, and average hourly earnings jump, and none of those may be real. Here's the problem. Let's go to the chart that I prepared here, and for those who are on radio perhaps and can't see it, what they did was what they do every January, and that is revise the benchmark numbers. And you go back and you look at what happened earlier in 2021. We had huge job losses in June and July, and you can see the revised numbers, they're much lower than the blue line of the initial release. So now we get a little bit of a makeup from that. They moved the numbers around, not necessarily adding jobs. And so it looks like we come out just about even. Then you take a look at the average hourly earnings, and there were big gains in the number of, in the amount of earnings from people who get in higher paid jobs, say financial activities, information. But leisure and hospitality, the low paid workers, we thought they would pull down the number. They only gained like 1 cent in the last month in their earnings. So this is a composition effect, and what the Fed's going to have to do is go back and look month by month and put those average hourly earnings into the context of which category got which kinds of gains, and it's not going to look as exciting as it did. The BLS puts a note in here, John, that says the participation rate was pushed up by 0.3% because of the revisions. And so we stay at 61.9 if you don't have the revisions, and so there isn't a big gain. So I think what the best thing to do here is to go back to the original advice we had, which was ignore the report, except for a different reason.
Mike, go away. I cannot keep up this morning. Thank you for breaking that down. I appreciate it. I want to go through what's happening with the price action at the moment. Amazon's up about 11% in the pre-market. It's a monster move. It's a big, big move. Amazon is up, and it's up big time. The NASDAQ 100 is now negative 0.6%, even with that massive move that we're seeing on Amazon. When you look elsewhere and look at the front end of the bond market, twos are shifting higher. Got a 2-year yield up by 9 basis points now to just short of 130 at 129. Got a crude at the moment. Crude price is picking up. On Brent, just short of 93, 92 on WTI. Got a real breakdown in the Italian debt market as well. Rick, we've got these really big moves everywhere. Cross-asset. Italian yields yesterday through to this morning. Looking at crude, just this slow grind higher, continuously, resilient, push, push, push. And now I'm seeing trillion-dollar tech stocks with 10, 20% moves on an earnings print, Rick. Is there some signal here for you?
There's a lot to do there, Jonathan. I mean, so, you know, firstly, I mean, when you talk about you're moving in my career, I've never seen moving. You're talking about hundreds of billions of market cap shifting in a day for individual companies. The numbers are staggering in terms of what this is. what we're trying to do within it, you try and step back and put some perspective around it. Listen, we've got a process here where policy is behind. You've got to move policy faster. You've got some changing dynamics around companies. I mean, you look at the dispersion of these earnings reports that have come out, and you look at the Amazon number, the Microsoft number, the Google number, obviously relative to the Meta number. By the way, you see that in some other companies. There's some real dispersion. I think at the end of the day, what it tells me you've got to do in the way we're running our portfolios, you've got to be a bit smaller. By the way, the depth of the liquidity in the markets today is amazingly thin. So you've got to think about, gosh, do I want to hedge a lot? Not really. I want to skinny down the portfolios. But then there's some opportunity here. I mean, yesterday, quite frankly, think about Amazon yesterday. It was down 7% on the Meta news. And you think about that was an opportunity yesterday. And, was there an overreaction? Markets are, because there's no depth of liquidity, markets are overshooting both ways. And so you just got to step back and say, okay, where are we going? Where are we going to be 2 months hence? Yeah. And then try and position around it. Not easy, I will say, because the whippiness of these markets.
So, Rick, are you carrying more cash?
I don't know if I can carry any more cash than we're carrying. Yeah,
so, what's the cash position right now, Rick?
We run a lot of portfolios, but we're running portfolios, over 13, 14% cash, some well above that. And listen, there are some opportunities. By the way, we also run, part of how you do that is you create shorts in some of the market. Your point about Italy, you think about how for the last few years, we've had this incredible support from the ECB, and you think about how indebted that country is, but you had a big buyer. Well, that buyer steps away. You think, why do we need to own Italy at these yield levels that are well through where U.S. Treasuries are? You changing the paradigm. I mean, this was a big week in terms of pivots, in terms of secular change, in terms of how you think about some of these markets. And you got to step back, think through that, and then reposition portfolios. And then, quite frankly, be smaller in the broad environment we're in is tightening. And you've just got to be smaller in your asset expressions.
So, Rick, smaller 1, 2, geographical breakdown. Let's just finish there briefly. Big pivot from the ECB. Might not resonate stateside in quite the way maybe it should, but I think it's a big deal after what we've seen from the Fed and now the ECB too.
It's a big deal.
What's your geographic diversification look like at the moment then, Rick?
So it's a great question, Jonathan. So I'll start with, by the way, it is a big deal. I read through that transcript again on the ECB. It's a big deal. That is a significant shift. So what do you do in Europe? And I've talked about it for months on your show. I mean, the area I still like and quite frankly accelerate a bit more in Europe is the European banks. And if you said, gosh, they're still trading below book. They've got a kicker of a better rate paradigm, which has been hampering their ROE, return on tangible book for years. So the banks still look attractive there. People have been piling into U.S. banks. I don't think the U.S. banks are as interesting if you're going to be short interest rate exposure, because I'd rather just have that as a pure expression of your rate exposure. So I will say we still like the U.S. and we still think there are opportunities in the U.S., but there are parts of Europe that we think makes sense. But we're overweight. Our overweight will continue to be the U.S. I will say one thing that is interesting. Emerging markets had their tightening process last year, and EM has gotten pretty cheap, and it's now DM. It's now the developed markets that are accelerating. So the question is whether EM can outperform, and we've both in equity and debt. We're starting to weight ourselves into that. You got to be careful because in a tightening process, still hard in EM, but we do think there's some opportunities in EM. Both.
Okay, guys, as you can see, we sold another position on euro at 114.45.6. We have 1,000 pounds in profit. Well done, guys, who decided to stay with me and follow my trades. And I'll speak to you later. Let's see what other opportunity will bring us today, what other pairs will give us nice, decent profit today. Stay safe. I'll speak to you later, guys.
Let's take a look at where we are with Amazon. We talked yesterday, right? Facebook wiping off $250 billion of its market cap. Amazon, they're about to add about $150 billion to their market cap. You're looking there in pre-market, still up about 12%. You want to talk about inflation. John, one of the key points of this report is they are raising that prime rate to $119 to $139. That's about 20 bucks. They've typically done this about every 4 years. But in my eyes, this is a clear sign that inflation is here and it is here to stay. Once you raise those rates, you don't cut them once inflation goes away. Let's also quickly talk about AWS. That was a really big point. That cloud unit, the most profitable unit of the business, up 40% year over year, $17.8 billion. And quickly here, advertising. We thought Facebook was hinting that advertising was bad. Not so much for Amazon. They jumped 32% year over year to pull in almost $10 billion.
What a move we're seeing on Amazon, the broader market too. Taylor Riggs, this is nice. Thanks for being with us. We're going to have some fun this hour. Mohamed's going to join us on the phone. Mohamed Al-Arian, just moments away. We'll get him on the phone to get his thoughts on the payrolls report, what's happening in this market too. And we've got to talk about what's happening globally. All around the world, investors gearing up for a tightening cycle.
Significant change in rhetoric from central banks. The BOE, of course, hiked. The Fed is gearing up. It's a big year for policy change.
That's up next. This is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
In the coming months, and as long as things play out broadly as we expect, we would expect to see a further modest tightening of monetary policy, which would embrace a rise in the bank rate.
The Bank of England is ready to go again. The ECB at some point, maybe this year, could join in. The Federal Reserve still hasn't moved. We're waiting for that. It's one of those numbers this morning that just grabs your attention. It's really sticky. 467 positive, 467,000, a monster upside surprise. 125 was the median estimate, but that really hit what was happening beneath the surface. Some people out there expecting a big negative print, maybe negative 200, maybe negative 400K on a payrolls report. It was not that. It was a massive upside surprise. And for that reason, Mohamed was going to sit out today. He's going to join us now. Mohamed Al-Arian of Bloomberg Opinion and Queen's College, Cambridge. Mohamed, you couldn't stay away. What a surprise. What's your response, sir?
It's a huge surprise, and even if you try to explain it away, it's going to impact expectations in a significant manner. It tells you that the Fed has fallen further behind the curve, and we are seeing fixed income markets price in the Fed having to do even more, and that in turn, John, is going to raise concern as to whether the Fed isn't already in the grips of a policy mistake, the second one in 2 years.
Let's be clear about what's expected right now, Mohammed, and the guide we've had from Fed speakers coming into this print. To some degree, they've poured cold water over 50 basis points. We get an inflation print next week. I've gone through the estimates a couple of times, all through the sevens, from, say, 7 up to 7.6 for CPI next week. What are the chances, Mohammed, that they make a move bigger than 25 basis points?
I think it's 50-50. You saw that the Bank of England surprised this week when 4 of the 9 members of its policy committee voted for 50 basis points. That came as quite a shock to the market. At least the Bank of England recognizes, and they've recognized it early on, that they can't get this inflation, allow this inflation narrative to get out of control. The Fed is not there yet. It is not providing any forward guidance. It has lost control of the inflation narrative. And if it's not careful, the market is going to start pricing in something that goes well beyond what this economy can absorb.
Do you think we're already there? Mohammed, you've talked about that a couple of times, but you and I have said that for about 6 months now. Aren't we at that tipping point right now?
You know, we've always said that there is a window for an orderly normalization, but that window is small and getting smaller. Today, it got even smaller. You know, if I was at the Fed, I would really worry about what I will end up contributing to in terms of undue volatility and in terms of undue damage to livelihoods.
So the will is tough because we don't have a crystal ball. We don't know what they will do. Let's talk about the should. Let's sit there just for a moment, Mohammed. Bank of America at 7 hikes for this year. There's a big pack at 5, others at 3. I imagine they might change. Where are you? What do you think they should be doing this year? And the kind of policy tightening that you think they can engineer with that window in mind that still delivers a soft landing?
So, John, I don't think this economy can easily absorb a bunching of 3 contractionary policy measures: ending QE, raising interest rates in an aggressive manner, and starting QT. Because of that, I've been advocating, you know, on and on since last summer, start early so that you can avoid this bunching. I worry that at this point, the bunching has become highly likely. It's not definitive, but it has become highly likely. So we are now way, way far from the world of first best on policy responses. You're in the world of third, fourth, or fifth best. So it really comes down to a question of not whether you're going to make a mistake. That mistake is being made. It is whether you can minimize damage. So I wouldn't go for 5 to 7 hikes. I think ultimately this economy can absorb about 3 hikes in addition to QT, in addition to elimination of QE. Anything further of that would be an over-tightening. And that's unfortunately the tricky situation that the Fed has put itself in.
So just finally, before you have to go, because I know you've been really kind with us this morning to give us so much time, Mohammed, what's your market call, given everything you've just said?
So I would stress what you also heard from Rick, is people should recognize they are navigating in very treacherous market liquidity-wise. You've seen the moves. They have to do with quite a few structural factors. I put out a Bloomberg opinion piece on that last week. So you do not want to be forced out of positions. So just be really careful, because we are going to see and we're going to continue to see outside moves in assets. And the most important investment mistake to avoid is to be forced to do something at the wrong time. So make sure that you can live through the sort of volatility that we're going to continue to see for quite a few weeks.
Mohammed, thank you, as always, for joining us, sir. We appreciate it. Mohammed Al-Arian on that big upside surprise on a payrolls report, just trying to keep up to speed on what's happening in the equity market too. Down a 10th on the S&P, off the lows on the NASDAQ, unchanged now. We get lucky this morning, we get luckier. Anastasia Amoroso and Mike Collins join us now for their reaction. They're going to be sticking with us through the opening bell. Anastasia, just quickly, your response, please, your reaction to this.
Well, it was always going to be a surprise as far as the payrolls report was concerned, given the range of outcomes. And we got a positive surprise. I view that as a positive surprise that the economy is shaking off this pandemic and it's moving forward. But of course, I agree with Mohammed. I agree with Rick that the Fed is further and further behind and they're going to have to catch up. And I think it was Mario Draghi used to say that we do not pre-commit to future path of policy. In this case, the Fed has pre-committed to raising interest rates and they should do it.
Mike Collins, your take?
Yeah, I'll make 2 points on today's report, right, and then focus on the big picture. So as Mike McKee eloquently said, it's a statistical mess, right? I mean, you really have to take these monthly numbers with a grain of salt. Two, average hourly work week hours fell. If you multiply the big number of jobs gains times the hours worked, aggregate hours in total actually declined slightly, all right? So there's something for everyone. But remember, the Fed has already checked the maximum employment box, Jonathan. What are they going to check it twice? I mean, they are focused on inflation. It is all about inflation. Inflation is the most important variable in the world. Today, inflation break-evens or inflation expectations are falling, right? Because as the Fed moves forward, all these policy hikes, and I would add another risk to Mohammed's kind of, I call it the 1, 2, 3, 4 punch, right? Higher rates, end of QE, beginning of QT, and a huge fiscal contraction, all happening in like a 6-month window. This economy has never seen that kind of policy change and tightness hit it all at once. So you're going to continue to see the curve flatten here. Inflation expectations probably come down.
I don't know if you want to touch twos right now, given everything you just said, Mike. Do you want to buy 10s at 190?
You know, we're really still short twos, thankfully, right? That's the gift that keeps giving. We still have this big flattener on. But yes, we are certainly advising our clients, add duration on these sell-offs, right? In 3 years from now, Jonathan, long rates are going to be lower. That's a pretty high conviction view we have. In fact, right now, you look at what's priced in the market, hike. Actually, starting in like 3 years from now, the Fed rate, the Fed policy rate is actually expected to start coming down again already. So that's probably the most likely path.
Mike Collins, stick with us alongside the brilliant Anastasia Amoroso just to work through some of this price action at the moment. 5 minutes away from the opening bow. Looking at a bond market with a yield curve that's picking up again. Up 8 basis points on 2s to 127, on 10s up 6 basis points to 189. The curve just a bit flatter, but the whole curve shifting higher. In the equity market, futures look like this. Unchanged on the S&P, on a Russell slightly negative, coming down a tenth on the Nasdaq, up 0.2%. We need to talk about oil too. Crude at 1.8 to 92.75 on Brent to 92.10 on WTI. And we have to talk about some monster moves in this equity market, from Snap to Amazon. Big tech doing its part to erase the Meta earnings meltdown. That's all coming up from New York City this morning. Good morning to you all worldwide. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. there are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Is there anybody left keeping track this week? I believe we're at 1% on the S&P 500 coming into Friday. We've been all over the place. On the equity market right now, futures slightly negative, down almost 1/10% on the S&P. On the Nasdaq, up a little more than 1/10%. And Amazon, of course, up a whole lot more in the pre-market. There's the opening bell. Get straight to it. Let's get to the bond market. 10-year yields look a little something like this. On 10s, yields higher, 7 basis points to 189.76. On 2s, yields up 2, approaching 130, going into CPI next week, and we're looking for a 7 handle again. Euro dollar. Euro's seen some strength recently. We erased that coming off the back of the payrolls report. Euro dollar flat now to 114.37. Crude with a lift, $92 a barrel. We had a little look at 93 on Brent, 92.12 right now on WTI, up by more than 2%. So here's your open, 25 seconds in, up a little more than 1/10%. Consumer discretionary up by more than 3%. We'll touch on all of that in just a moment. Energy up by 0.75%. The financials up a little more than 1/10. No doubt the bond market helping their cause. Everything else, at the moment, at least, in negative territory. Want to get straight to one name, the name we've talked about for much of the last 12 hours. Amazon, up by more than 11% in early trading. Joining us from the West Coast, let's get to Ed Ludlow for more. Hey, Ed.
Good morning, John. Look, Amazon has proved that it is greater than the sum of its parts, right? This has been a wild 24 hours in equity markets. I'm sure that some on Global Wall Street would agree. Let's get straight to EBS. This is a profit machine, monster profit, right? We knew about the challenges in the supply chain, labor costs, higher input costs, slowing online sales, but advertising and cloud step up. And that is what boosts the bottom line for Amazon. Yes, okay, they realized a gain on their investment in Rivian, but $27 EPS, I mean, that's just a massive beat. And, you know, it just reinforces in this earnings season, if we bring up the year-to-date performance of these mega caps, just how much of an outlier Meta was, right? Because Amazon has really solidified this idea that the street will go back to these tech names that they favored for a reason over the last 2 years. Look at the earnings projections for full year 22. They're all increased, apart from one name, Meta Platforms. And that chart really says it all, doesn't it, John? Come with me very quickly then into my Bloomberg terminal and look at this chart. Meta trading at a 35% discount to the NASDAQ 100, right? Its lowest relative price to earnings on the NASDAQ 100 ever. A lot of names on the street cut their price targets in the near term, but maintained their bullish outlook. I then go back to Snap. Look at what Snap's trading at now. The narrative around advertising is strong broadly, not with Meta. So there's a lot to unpick here on what went wrong. I still don't think we've quite answered that question. But I ask you, John, is big tech back? Maybe.
Amazon is a fair bit, at least in early trading. Ed, thank you, sir, as always. It's a move of 9.4%. That 9.4% for a stock as large as Amazon is worth $134 billion. Dan Ives of Wedbush says this: multiples will compress, but the underlying growth for the tech space is being underestimated and will thus neutralize some of these perceived Fed tightening headwinds. We can get into this. Anastasia Amoroso, Mike Collins. Anastasia, let's start right here. A $130 billion move in market cap on a single name. Anastasia, what's that about?
Well, it's about a big bifurcation that we see in the tech space right now, and we just see this seesaw every single day. But the reality is we are shaking off the pandemic, and some of the names that have worked so well during the pandemic have seen their multiples and earnings expand. We're not going to see that going forward. Whether you look at Facebook or Peloton or Zoom, what's happened is a huge pull forward in demand because of the pandemic. But now that we're coming out of it, they have to re-engineer for the next phase of growth, and that's going to take some time. So that's why some of those stocks have been beaten up and they've dragged down parts of the market. But I'm very encouraged to see that part of the big tech cap trade is still very much on. And whether it's Amazon, whether it's Google, you clearly see that there are parts of tech that are having problems, but there are parts of tech that are very strong and getting stronger. And case in point is cloud computing, for example. As much cloud capacity as we've added today during the pandemic, there's much more to go. And that's what a lot of the chief tech officers are going to be spending on. So you see parts of big tech trade benefit quite a bit from that. And I completely agree with the quote that you showed from Dan, is that, yes, of course, the valuations have to reset to account for Fed tightening policy. But guess what? They already have. If you look at the NASDAQ, we went from 34 times multiple to 26 times multiple on the NASDAQ. And at the same time, we're seeing earnings come through for a big chunk of the technology sector. So I think there's a lot to do within tech on some of these really bumpy and wobbly days.
You're talking about the fundamentals, though, and if we can put those single names up on the screen again and just look at some of the performance here. Amazon being one, talked a lot about that, up 9 or 10%. Snap is flying. Snap's a $57 billion company. Now, for a little bit of perspective for you, Barclays is 33 billion sterling. If you saw a move like that in a bank stock, 40%, we'd be wondering what on earth was going on in the world. Anastasia, are we struggling to value these companies day by day? I mean, this is pretty confusing stuff to see these moves this big.
It is, but I think what's happening is there's a bit of a tectonic shift within technology, and there's some older school tech names that are not working as well, and there's competitors that are creeping up on his back. I mean, one big trend for me, John, and I think Facebook and Snap come into this conversation, is this change of perception around social media, centralized social media that collects your data and doesn't give you a whole lot of data privacy. If you look at the crypto community, there's a huge move towards decentralized Web 3.0 that emphasizes user privacy. So I think companies that are aligned with navigating data privacy that is going to be more stringent, and obviously Snap has done a better job of this than Facebook did with the Apple privacy changes. I think those companies that prioritize user privacy, that position for the next trend, which is augmented reality and metaverse, I think those companies are going to continue to differentiate themselves. But there's clearly a changing of the guard that's happening in tech right now.
It's a monster changing of the guard. Snap at the moment up more than 40%. Mike Collins, are you seeing anything like this take place in credit?
Yeah, absolutely, Jonathan, right? I mean, it's like a one variable world, right? It's all about inflation right now and the Fed's reaction function to that and other central banks' reaction function and the impact on real rates and the impact on risk asset valuations. It's all feeding through. They're all pretty correlated. I mean, we've expected to see credit spreads widen here and along with equities valuations coming down as more rate hikes get priced in, as tighter policy gets priced in, right? It's almost a one-to-one relationship. And that has happened in a pretty big way, right? I'm looking at this investment grade corporate index, and it has been widening pretty substantially so far this year, starting last year, right? So the question is, when do you get back in, right? When is the opportunity to add risk, whether it's in investment grade corporates, high yield equities, or maybe even emerging markets? And maybe you need to see inflation indicators start to peak and roll over, which we haven't seen yet. And maybe you need to see the peak hawkishness of these central banks start to ebb. And we're not really that close to that yet. So we're being patient on the credit side.
We might have to wait until Q2 and hold that thought, because I want to come back to you on credit. So we've got Amazon up by 9%. It makes up what of the NASDAQ 100? I think 6 or 7%. There we are, about 7 percentage points of the NASDAQ 100. And we've still got the NASDAQ lower today. On the composite, the NASDAQ down a tenth. On the S&P, we're down 0.2%. Kaylee Lyons, keep up with this one.
It's very, very difficult to do, John. Of course, Amazon, one of those companies that benefited in a massive way from the pandemic. Due to its other business lines, it's holding up a little bit better. But for a lot of one of those once mighty pandemic trades, they're not doing so well. Peloton, one example, down more than 80% from its record high. Also the likes of Zoom, of Netflix, of PayPal, which reported earlier this week. Just to zero in on PayPal, it fell 30% over just the previous 2 days alone after reporting earnings on Tuesday, after total payment volume for the company rose just 23% in 2021's last quarter, which missed expectations, smallest increase in 2 years. Obviously, the company hurting as the economy opens up and people aren't spending online shopping dollars as much and using PayPal to do that. That has brought the stock back down to earth. And I would note, John, PayPal actually used to trade at near double the forward PE multiple of the NASDAQ 100. They're now roughly in line, but at 25 times for the NASDAQ 100, that is the lowest valuation for that index as a whole, going all the way back to May of 2020. Still, though, that is 30% above the 10-year average. So it goes to show you, John, even as we've seen a lot of these tech names, a lot of these stay-at-home names coming back to earth, they're still really richly valued relative to history.
Kelly, thank you. And for everyone just tuning in, big upside surprise on a payrolls report, 467,000 positive. Big upwards revision as well to the previous month. A lot of details that Mike McKee went through a little bit earlier that's worth paying attention to, but big upside surprise and big move in the bond market too. 2-year yields up by 9 basis points, just short of 130 at 129, through 190 on 10s, up 7 basis points. Chris Harvey of Wells Fargo, almost called him Chris Fargo, has this to say: we're getting late in the cycle. The tide will no longer lift all boats and the market will become less and less forgiving in our view. Going forward, we feel investors will need to cut losses quickly and to focus on margins rather than the top or bottom line. Anastasia, can I throw that at you? Margins, they held up really nicely through 2021. Can we repeat the act in 22?
I think it's going to be hard. We certainly should not expect any upside in margins. And I think some industries will fare better than others in terms of preserving their margins. I mean, some of the sectors that I'm concerned about in particular are consumer staples and some of the consumer discretionary names, because the margins for those tend to be low to start off with. And also as wages continue to rise, and we just saw a 5.7% increase in wages, those margins are going to compress. And any company where the revenue per employee tends to be very low, I think is quite susceptible from this trend. But if I look within other pockets of the space, and once again, I have to steer to software here and parts of technology, margins for that sector are very, very high. For example, for the infotech sector, the margins of 24% are actually double that of the S&P, which is roughly 12%. So that gives you a lot more room to absorb, whether it's higher wages or supply chain disruptions and so forth. So that's why I think on the days like we had yesterday, investors can't help but pivot back to tech and pivot back to software, because once we settle out on the other side of this, and once the Fed moves rates somewhat and the economy slows down somewhat, it's going to be back to the where's the growth that we can count on coming from, and it's going to be from these secular trends that are playing out in tech. And John, if I may just add one more thing. We talked about being more discerning in the market, and I do agree. I think it was Rick who said this, that this is becoming a more narrow market, and we can't just bet on one big beta trade because of the Fed. We have to be more select and find some of those pockets of alpha.
Mike Collins, I'm just getting some response from Scott Minerd over at Guggenheim. He's just sent me a personal email. He's okay with me reading this out. I thought I'd share it with the audience. Here's his view. The Fed will be forced to tighten aggressively just as the economy slows from the lagged effect of stimulus runoff. Risk is increasing that just as the economy is slowing in real terms, the Fed will be fighting inflation. He goes on to say a toxic mix for real growth and financial assets. There is no way out of stagflation at this point. So that's Scott Minerd of Guggenheim. Just sent me that message just now, Mike. I promised to share it with the audience, so I have done. Can you comment on that last line, Mike, from Scott Minerd? There is no way out of stagflation at this point. Your reaction?
Yeah, so that's a world where demand slows and inflation continues to be really high. And it feels like we may move into a version of that world. We actually developed this really cool inflation indicator, Jonathan, where we separated the demand impact on inflation from the supply impact. Interestingly, demand is accounted for actually a little bigger part of the inflation we've seen, right? We have this huge fiscal stimulus, helicopter money, demand for goods surged an incredible amount. No supply chain in the world can keep up with that. But now, as you look at these indicators, the demand side is rolling over, albeit modestly, meaning the growth rate of demand is starting to come down, and the market focuses on second derivatives. And the supply side, believe it or not, and you're seeing a lot of anecdotal evidence in the last just few days, is starting to come back. So that supply and demand is going to meet at some point. The question is when. I would bet maybe by the end of this year, if not probably in the first half of next year. And that means inflation actually starts to roll over and come down. So I'm not a believer that we're stuck in this permanent high inflation world.
I'll revisit that line from Scott Minerd at Guggenheim in just a moment. Anastasia Amoroso, Mike Collins, sticking with us. We're here from the White House a little bit later this hour. We need to talk about crude with them. We need to talk about crude next, hitting a fresh 7-year high.
It's even beyond just Russia-Ukraine. It's also the longer-term ESG initiative. You know, I think as we're turning more green, we're going to have to live with higher oil prices.
That conversation up next.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada. Tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
We've been very clear in our response that if Russia chooses to go into Ukraine, launch another military invasion of Ukraine, it will face severe consequences. It will face economic consequences from the financial sanctions that we and our partners and allies have prepared.
Russia's Foreign Minister Sergei Lavrov brushing off U.S. claims that Moscow is producing a propaganda video. He said the following: I read on the internet that a State Department made some statements that Russia is allegedly preparing a fake video with an apparent attack by Ukrainian soldiers on Donbass. This kind of fantasy is delusional, in my opinion, and there are more and more of them every single day on this situation and what's happening in this commodity market. For more, here's AMH. Anne-Marie.
Hey, John, how are you? Yeah, Mr. Niet there saying he's taking to the internet, realizing what the United States is saying in terms of these potential false flags reports. Now, U.S. officials, Jonathan, have been saying that this is what Russia would do, but now we're getting a little bit more information. They're saying when they are trying to drum up these propaganda videos, they're even using things as corpse, and they're starting to align all of this. There was some pushback from reporters asking for more detailed information, but the State Department saying we will only declassify information when we have some high standards on that we think this is factual and true. So right now, this is where some of the tension is, Jonathan, at the moment. But still, diplomacy does still potentially could be a path forward. We do have Emmanuel Macron heading to Paris on Monday, and those talks will still continue.
We need to talk about that tension in the crude price too, Anne-Marie. That could be a problem. We'll catch up with the White House a little bit later. Good to have you in New York. Thank you. Back with us, Anastasia Amorosa, Mike Collins. Anastasia, you know something about Russia. Let's go there. The situation with Russia, the situation in this commodity market, and what it means to you as an investor at the moment.
Well, the situation in the commodity market, it continues to be a very tight market where demand is picking up strongly and supply is just not coming back fast enough. I mean, clearly the tension with Russia, I think, is adding to some of the upside here. But, you know, it really puts Europe in a predicament because despite all the talk about sanctions and what Europe and U.S. may or may not do towards Russia, there's such a great deal of dependency on Russian natural gas. And given what happened with the EU natural gas market, I don't think they want to see another spike. But if that does happen, if that's where we go and that's where the situation is, then I think that actually does provide potentially more upside for the oil market. If Europe all of a sudden has to switch from using gas and switch to oil as they did earlier last year. So all of that just presents more question marks around demand and supply for the market. I'll also tell you, John, that if you look at OPEC, for example, and what they say they're going to do in terms of supply and what they actually have been doing, there is a big gap that's emerging. And in fact, if you forecast this out some months down the road, there's close to 3 million barrel difference per day that we're going to have in terms of what OPEC said they're going to do and what they're actually doing. So all of that, coupled with very strong demand and some geopolitical uncertainties, I think sets up a very strong crude oil market. Against that backdrop, John, you look at the energy stocks, they've really rallied this year, and maybe they pare back a little bit of those gains, but at these levels of crude oil, energy companies are making a lot of money.
And Mike Collins, they're making a ton of money, and it means a lot to high-yield credit, as you know, 93 on Brent, 92 on WTI. You've run us through the strategy around treasuries. Short the front end, you'd be a buyer of the long end, maybe at around 190 on 10s. Where are you left in credit with energy doing what it's doing right now, Mike?
Yeah, I mean, the energy sector still has been one of our bigger overweights. Not that we predicted oil prices go to 92, Jonathan, but we did expect the fundamentals to continue to improve, cash flows to continue to improve, leverage coming down, and that's all happening in a really big way. So that's definitely supportive of their equities, of their credit. On the bigger picture, it's really interesting, Jonathan. Right? Normally, geopolitical risk is like a risk-off environment. It means, you know, growth slows, maybe central banks pause on their rate hikes. But in this case, it's adding to the inflation. Not to keep harping on inflation, Jonathan, but it's so important. Inflation is such a hugely regressive tax around the world, especially in Europe, where it has really hit hard. So these central banks have to fight inflation, even in the face of this demand slowing and these big geopolitical risks, which is a really risky environment.
And can I go back to that line then from Scott Miner to Guggenheim, and Anastasia, give you the opportunity to respond to it. I'll go through that quote again. The Fed will be forced to tighten aggressively just as the economy slows from the lagged effect of stimulus and that runoff. The risk is increasing that just as the economy is slowing in real terms, the Fed will be fighting inflation. There is no way out of stagflation at this point. Scott Miner to me over email just moments ago. Anastasia, the final word on that, the risk of the S word.
John, I would respectfully take the other side of that. And I say this for a couple of reasons. I don't think the Fed is really trying to hike to slow down the 7% headline inflation because they can't. That is not driven by demand. It is driven by supply. The Fed cannot fix the pandemic. They cannot fix the absences. They cannot fix the shortages. They cannot fix the port congestions. The governments, the administration, the governors have to fix all that by making sure that we get out of this pandemic and we get back to normal. So that's what eventually I think is going to happen. So the Fed is not going to hike for 7%. I think the Fed is going to hike to slow down inflation that we're seeing in the labor market, for example, and perhaps in the housing market. So if that necessitates 4 or 5 rate hikes and maybe another 3 or 4 next year, guess what? The real interest rates are still going to be below zero, slightly below zero where we are today. So yes, the Fed is tightening and they have many ways to do this, but I still think we're not nearly close to the level of neutral on interest rates in the economy. We're not going to be there most likely next year. So they're not really over tightening in real terms just yet.
Anastasia Amoroso. Anastasia, thank you. Thank you very much. Alongside Mike Collins, their reaction to the jobs market, the economic data and what's happening in this market right now, a massive upside surprise on payrolls, 467,000, the estimate 125K. Joining us now, I'm pleased to say, Marty Walsh, the US Secretary of Labor. Secretary Walsh, this is not the conversation that maybe you were preparing for yesterday or I was preparing for overnight. Can we just recall what you said earlier this week going into this number? Let's listen into that together.
We're living in very interesting, unique times. This is unlike anything that any White House has ever experienced before. Well, maybe 100 years ago. We're going to continue to follow the president as he continues to put plans out there to move our economy forward and moving people forward.
You were preparing us for a soft print, Secretary Walsh. We got a mega one, a fantastic one, 467,000. There's some interesting details beneath the surface. Just give me your take first of all, please.
Well, first and foremost, just for the clip, just to stay in line here, we are still living in very unique, interesting times, in the first in a century pandemic. But we look at these reports. Let me just touch on this two ways. Number one, the report for the month of January was a very good report, a very solid report. And I think underlying what it's telling us is that we're in a very different position than we were in March, April, May, June of 2020. We're seeing people in economies, in workplaces, and workers and employers really learning to live with the pandemic and adjust. So we are in a different place there, number one. The adjustments certainly is great to see, too. BLS is the gold standard when it comes to taking in numbers. We all know that in this country, and they're very transparent. And when I saw that number today, that was actually more surprising to me a little bit than the month of January. And I asked them, how did we revise 700,000+ jobs? And what was explained to me was over the last 10 years, we've had about the same revisions over that same period of time. So we're excited. I'm excited today. But you know something? We still have work to do. And this celebration can last for a little bit, a couple hours while I do these TV hits. Yeah. And then we got to go back to work.
Well, let's talk about what we've got to work on. The consumer at the moment, Secretary Walsh, just doesn't feel it. I can go through the data. I can talk about where unemployment is, where wages are. They feel the 7% inflation. They feel crude prices where they are. Crude through the 90s at 92. You saw consumer sentiment last week, decade low. What's the disconnect there at the moment for you, Secretary Walsh, and how do you and the administration fix that? How you say things are and how they look and how people feel at the moment?
Yeah, I don't know if it's necessarily a disconnect. I think it really is about how people feel at the moment. The American people and folks in this world have gone through a lot in the last 2 years with the pandemic, and I think there's a lot of concern about their family, a lot of concern about the virus, a lot of concern about if you've been vaccinated, the people that aren't vaccinated. If you're not vaccinated, you don't want to get vaccinated. So there's a lot of concern there. But all I know is that the president laid out a plan at the beginning of last year to get people back to work. 6.7 million Americans got back to work. The president laid out a plan to deal with inflation a little bit into 2021. We're working on those supply chain issues and other things. So we just need to continue to do our job. I think that you worry about the poll numbers later on, but right now you worry about doing your job. And as a former elected official, obviously you want to see the great numbers and you feel good about it. But at the end of the day, you still have to do your job. And the president is very focused on making sure he does everything for the American people, including not just bringing down inflation, but also bringing up wages.
Well, let's talk about the inflation side of it. Sneak peek of next week for you. 7.3% the median estimate, the high 7.6, the low 7. Going through some of the estimates, Lloyd's Bank at 7.6, Credit Suisse at 7.4, Morgan Stanley at 7.3. Caught up with Ellen Zetter of Morgan Stanley. They're looking for a punchy number next week. Secretary Walsh, what's the message going to be from the administration as we just keep seeing inflation kick higher and stay at these levels?
From where I sit, my job is to make sure that we continue to get people back to work. And, you know, I had a meeting with Secretary Yellen earlier this week. We talked a little bit about inflation. We talked about the job market. We talked about creating opportunities for people. We talked about the infrastructure law that was passed and the investments that are going to be made there. So I'm going to continue to do my job, and in different parts of the administration are going to be working on the inflation side. I'm part of that as well with the supply chain. But you know, again, we're taking this a day at a time.
What does that mean when you say we're going to help people get back to work? What specifically are you in the administration doing to try and achieve that?
Well, certainly I'm working with governors and mayors across the country. We're making investments in job training programs. We're looking at the way we do job training and workforce development. In the infrastructure law, we're making sure that we're going to be working on pre-apprenticeship programs and apprenticeship programs to get more people into the building trades. We're going to be working on the supply chain. We're working on the trucking industry to get more people in the trucking side of supply chain demands that are happening in our country now. Last mile, you know, a lot of the concerns we have is not just bringing ships in off the coast to unload them. We also need to make sure the products that are on those ships get to stores, get to warehouses, get to Main Street America. So we're working to increase other jobs. We also saw one of the participation rates that we saw in that's growing is younger people, 16 to 21, people getting into the workforce. We need to make sure that as those folks get into the workforce, that we're training them not just for the jobs of today, but making sure they have really pathways into the middle class. So that's what I mean by that.
Secretary Walsh, just a final question from me, and allow me to go here. The Bank of England governor, Mr. Bailey, yesterday faced a lot of backlash for what he said about pay rises and workers, and he effectively said that the people in the UK shouldn't demand a big pay rise this year because it might cause more problems. I just wonder, as a union guy yourself, how you'd respond to a line like that, what your position would be on that debate at the moment.
I think any time that we see increases in wages for people, that's a good thing. We saw roughly 13 to 15% wage increase in hospitality. And what did we see? We saw more participation of workers in that industry. I think it's important to pay workers more. It's important to respect our workers. And it's important to keep our economy moving forward.
Marty Walsh, the US Secretary of Labour. Marty, thank you. I know you're super busy trying to explain this one to a lot of people after setting us up maybe for a soft print. We got a really, really good print. Secretary Walsh there, thank you very much. From New York City this morning, I want to whip through the price action for you very briefly. 30 minutes into the session, we look a little like this on the equity market. 0.2% higher on the S&P. On the NASDAQ, up about 6 or 0.7%. Looking at the FTSE, we're down. And in Europe, we're down even harder. We're negative 1.7% on the equity benchmark in Frankfurt, Germany. Over in Europe, just away from the US for a moment. Yes, we've got a move here on twos in America, up 10 basis points to 130 almost. Look to Italy. There's some real tension here that I know Guy Johnson's going to pick up on briefly. Up 10 basis points on an Italian 2-year to 0.27. That yield was in negative territory a little bit earlier. From New York, I'll leave you with that. I'll catch you up with you a little bit later on Bloomberg Real Yield. From New York City, good morning to you all. This is Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome to Ameriprise. I'm Sam Morris, and my brother Max recommended you.
So my best friend Sophie says you've been a huge help.
At Ameriprise Financial, more than 9 out of 10 of our clients are likely to recommend us.
Our neighbors, the Garcias, love working with you.
Because the advice we give is personalized.
Hey, John Reese Jr.
How's your father doing? To help reach your goals with confidence.
My sister told me so much about you.
That's why it's more than advice worth listening to. It's advice worth talking about. Ameriprise Financial.
I really needed to lose some weight for health issues. I didn't want to have a shortened lifespan. Having my wife do this with me is priceless.
Get Nutrisystem's partner plan.
We've lost 85 pounds with Nutrisystem.
Weight loss is better together. Partners lose up to 20% more weight.
I could cheer her on, she would cheer me on.
And it's an easy plan. You eat the meals, you lose the weight, you feel better.
Eat the same meals or choose your own, including new premium meals with up to 30 grams of protein and new skillet dinners ready in minutes.
It smells great. It's like, okay, it's dinner time.
And we're bringing the taste of your favorite restaurant meals right to your home, perfectly portioned with half the calories. Get food for 2. Meals and snacks delivered together free. Act now and get 50% off, plus an extra $50 off.
That loves us. This is us.
Go online or call 877-326-SIZE to save 50% plus get an extra $50 off.
Competition beat us again.
How?
They have a better finance system than we do.
I feel like they might have a better finance system than we do.
Workday.
How do they make better decisions faster?
Workday.
It's gotta be something.
Workday.
I think I got something.
Work.
I think
Hey, Rob.
You're on mute.
You're on mute.
Hello.
There you go.
Hey, there he is.
Workday, the finance, HR, and planning system for a changing world.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Friday, February 4th. Here are the top market stories we are following for you at this hour. A massive jobs surprise. The January jobs report blows estimates out of the water with 467,000 additions plus an upward revision for December. Wages up, participation up, bond yields go up too. What does it mean for the Federal Reserve? Amazon amazes. The company posts a blowout profit thanks to the cloud and advertising, plus raises the cost of Prime, sending shares surging toward one of the largest, biggest one-day market cap gains in history. And what a week again. The best four-day streak for stocks since November 2020, followed by the biggest one-day drop for the NASDAQ since September of 2020. It's been another volatile ride for equity investors, and the week is not over yet. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, happy Friday. This week felt like a long one, and more excitement this morning.
Yeah, it's as it was yesterday at this time, Kaylee. We're in a situation where I don't know where to look. There are so many big stories. The macro story is absolutely front and center, but then you kind of fold in what's happened with Amazon and think about what's going on there, that huge gain we're seeing. I think you probably need to look at that over a few days really to get the real picture. You've seen really choppy trading in Amazon this week, but the payroll number obviously is a huge figure that we need to focus on. I think you're right to focus on the revisions. I think that is an area that we need to explore a little bit more, what's happening with the BLS data. I know the Labour Secretary addressed that. And then you've got to think about what is happening over here in Europe as well. The handbrake turn that both Christine Lagarde and the Governor of the Bank of England, Andrew Bailey, delivered yesterday, absolutely eye-watering, and the effect in terms of the rates market continues to be felt. Italy up sharply, Greece up sharply. The story goes on and on and on. It has been a story really of a macro mess, a top-down story that we're kind of trying to figure out this week, and a bottom-up earnings story which we're trying to factor in and fold into that story. But the number of the day is definitely 467,000. That is the number that we got delivered on our Bloomberg terminals. The payroll number blowing past all expectations. Even the Labour Secretary sounding a little bit surprised just a few moments ago.